Are your top stories. Global bond yields jump after more hawkish commentary from Fed officials. Euro area inflation in focus today as European stocks are set to fall at the open. Tesla shares tumble after hours as Elon Musk's plan for the EV maker offers no details on new cars. And China warns, quote, hedonistic bankers to clean up their acts and toe the Communist Party line.
There you go, to those hedonistic bankers. Let's see where President Xi ends up on this. This is a picture for the futures. We have quite a lot of data coming up in Italy and the Netherlands. And for the moment, DAX futures down 0.4%. FTSE futures 0.1% lower.
Yeah, the surprise around the German inflation print yesterday, the Eurozone inflation print coming out, the expectations of 8.3% year on year. And of course, the consequences of the markets gear up around expectations that the ECB will have to go higher for longer, and of course that's being reflected in what's happening across the bond space as well. Stateside markets now pricing in around 5.5% by September for the terminal rate, some even betting on 6%. Again, another readjustment for these markets. Fed officials coming through the route. So Bostic and Neil Kashkari suggesting they want to see at least 5%, above 5% to crush inflation, and services a concern for Kashkari. The FTSE 100 currently down 0.4%, and not there at 33 points for the main UK index. The Spanish IBEX down 0.6%. Let's have a look at yields. Let's have a look at the US dollar then. The dollar is back today after the softness that we've seen. Bloomberg dollar index gaining 0.3%. Last time I checked, euro dollar was around 106. Futures in the States looking to losses of 0.7% after the S&P closed yesterday and its lowest level in 6 weeks. Here's the yield story then. The 10-year at 4%. It's crossed that 4% level. Is that now looking like it has value in the 10-year? 4 basis point move, again high in terms of the yields on the benchmark stateside. The 2-year in Germany, I want to bring this to your attention because since the start of February, so in about 30 days, the space of about 30 days, you've seen a move high in terms of yields by about 70 basis points at the front end of the curve in Germany. 323 now on the German 2-year, and a move high again of 3 basis points. Francine.
Yeah, so there are a couple of news stories that we're following out. I think in the last couple of minutes, Tom, we also found out that China is planning to put around $1.9 billion into its top chip memory maker. Now, overall, we're seeing quite a lot of pressure. If you look at the 20 groups that make up the stock 600, only one is on the up. That's energy, about 0.2% higher. But otherwise, again, inflationary pressures, hawkish comments from the Fed, a sudden realization that the China reopening means a lot more demand also for some of the commodities, and that's putting pressure in equity markets. Let's also get over to our markets reporter, Valerie Teitel. Valerie, good morning. You're looking at U.S. data, and in particular, the ISM manufacturing print yesterday.
Yes, Francine, the ISM manufacturing print had some concerning things, one of which being this unexpected jump in the prices paid sub-index. Now, the forward-looking sentiment indicators in some way lead the hard CPI data, and you can see that in my chart here with this white line clearly leading the yellow line, which is the core goods CPI. This unexpected jump led to another bond sell-off yet again. We saw the 2s10s curve flattening to yet another extreme. That's as these 2-year yields continue their relentless march higher. 2s10s curve on that Treasury curve hit a negative 90 basis points, and that move extended in the Asia session. It's been quite a month, quite a move. We're all waiting for perhaps a pause in this sell-off, but it doesn't look like we're going to get it this week. We have jobless claims today ahead of the ISM services print on Friday.
Mr. Robosa, Valerie Teitel, thank you very much indeed with the preview of the importance of that data. Fed speakers again hawkish increasingly around the needs to get inflation down, and interesting to hear from Nir Kashkari around his concerns about services and the concerns that the Fed is not doing enough to tackle that. Now, German inflation unexpectedly accelerated in February, further complicating the ECB's task after overshoots this week in other parts of the continent. For more, we are joined by Bloomberg Europe correspondent Maria Tadeo. Good morning, Maria. A week then of hotter prints. Will the Eurozone reading confirm this trend?
Tom, that is a big question this morning, and I wonder if you guys are also on countdown here until it comes out in about 2 hours' time from now, because this is a number everyone is focused on. And the idea is, are we going to get a repetition, a reiteration, as you alluded to, of the hotter prints that we had in Spain, that we had in France, that we had in Germany yesterday? And of course, this number, the CPI number, is always important when it comes to the euro area. But now, of course, the timing makes it even more relevant because we have a European Central Bank decision in 2 weeks' time. Now, for March, it's pretty much baked in as a 50 basis points hike. But with this kind of data, and I think this is really the core of the issue now, will it justify a back-to-back 50 in May? So that's really where the debate is at, and this also makes the number today even more relevant.
And Maria, you had a wonderful interview with the Bundesbank president, Dr. Joachim Nagel, yesterday. It's very clear that what the ECB does from now is going to be very complicated, and he basically thinks that the market has understood it a little bit more.
Yes, and we spoke to Mr. Nagel yesterday, and in Frankfurt, to me that was interesting because I asked him, you know, there has been this change in zeitgeist this week. We've seen the pickup in rates to 4%. Is that a narrative that you feel comfortable with? He would not endorse the market moves because obviously he would never do that in normal times to tell the markets what they're doing is right. But what he did say, however, is that he feels more comfortable with the narrative that is being shaped this week, that the ECB is going to have to tackle inflation harder on. In fact, I asked him, what do you expect for March and going forward? What do you see? This is what he had to say. Let's take a look.
It seems to be the case that inflation is very stubborn. And that is bringing me to the point that monetary policy has to be more stubborn. It's not fair to speculate what is the sequencing beyond March. But it looks like for the moment that 50 basis points for the March meeting, very necessary.
And that was Joachim Nagel, of course, the head of the Bundesbank. And you heard it there. For March, 50 basis points is very necessary. I asked him, what about March? He said it's early to speculate. But when you have inflation that will average in Germany 6 to 7%, it means the job is not done.
Okay, Maria Tadeo, thank you very much indeed on the calls there for 50 basis points in March. And you would expect that to accelerate if indeed we get a hotter print later this morning in terms of Eurozone inflation. Let's bring in Tobin Deputy Chief Investment Officer Tatiana Pouhan. Tatiana, before we get to you, getting a few lines from the ECB, if I can get my terminal to behave, around, of course, Madame Lagarde speaking. I'll get those and I'll bring those to you shortly. But let's start with the inflation picture here, Tatiana. How much more work is needed from the ECB in terms of the level of rates and the longevity that they'll have to be held at to get inflation to behave?
Yeah, I think I pretty much agree, with the German Bundesbank that inflation tends to be very sticky, and it seems to be really very difficult to get this under control. And my kind of scenario since quite some time now is that they need to go way beyond the heights, that have been priced in so far in the market. And it means for me also that we will see a lot more coming and significant heights from the ECB, but also from the Fed.
Tatiana, let me bring you what Christine Lagarde is saying. So half-point ECB rate hike is needed in March. That has been telegraphed, I think, very, not only daily, maybe hourly by her also ECB team. She says they must take all necessary measures to tame inflation and possible that ECB continues rate hikes. When do you think we reach peak rates? Does it have to be September or could it be later?
I think we should be ready for a scenario, where it's going to be later. And I think, a tipping point could actually be that the ECB might reach a point where the mountain of debt, that public households have accumulated over time will make it actually very difficult from a political point of view for the ECB to go further, because it might really put into trouble countries like Italy or like Spain to be able to sort of, carry that burden. And so in some moment in time, we could actually find ourselves in a situation where inflation remains sticky. Rates should be hiked further, but, the ECB also, has a huge problem with potentially putting those economies into deep trouble.
So what is the potential downside for the equity markets in that environment, Tatiana?
I think equity markets are still fairly overvalued. And I continue to, reiterate this narrative. And I think 10% in a shorter period of time and even 20% over a longer period of time, let's say until year end, is something that, could actually materialize if, we see that interest rates need to increase significantly further. And if we also see that geopolitical tensions continue to rise as we see it now with China, with Russia, and so on and so forth.
But Tatiana, should we not be able to, how can we not take a call on that now? So where do you see ECB rate peaks to be? And if China fully reopens, then how much more pressure does that put on demand?
Well, obviously, China reopening can put, some pressure on demand and will put pressure on demand in the shorter term. But what I think what should be relevant for investors is not only, a very short-term picture, but I think we should have a longer-term view on what might happen. And what I see happening currently with China is, from my perspective, is something that I find very dangerous, which means that China becomes more and more, a country that is kind of pulling back from, an opening towards the Western world. And that is putting a big risk to investors, to foreign investors. And I would really reconsider, the strategy running into China, investing into China, because from one day to the other, this could really fire back at you.
And you flagged the geopolitical risks, Tatiana, very clear about that, and your concerns that maybe investors haven't woken up to that, particularly around China. But how do you ignore the world's second largest economy? Is there not a tactical, at least a tactical play here around Chinese assets?
Of course, it's very, let's say, tough to say, that you should sort of, try to be cautious or try to ignore, let's say, this world economy. Of course, it's a very interesting market, I agree. But, there are also other interesting markets. And again, from a longer term risk management perspective, I'm not so sure, whether we really want to trade with a country that has its very own agenda, and an agenda that just might, from one day to the other say, hey guys, we just take, your investments. It's not yours anymore. We expropriate your assets. And then I think, foreign investors will realize how naive they've actually been by running into this market and by being greedy about making profits in that market.
Okay, Tobin, Deputy Chief Investment Officer Tatiana Buchan staying with us. Get more of her calls, particularly around the earnings picture in the next few minutes. And coming up, talking of earnings, premium beers propel the world's largest brewer to a profit beat. Bit of concern, though, around some of the premium offerings and the demand in the US. We're going to delve into the earnings details from AB InBev. That is next. This is Bloomberg.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody's talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
breaks. No one covers the world like Bloomberg.
6 people have died from these latest quakes, adding to the 41,000 plus people who've died in those major quakes 2 weeks ago.
A top Sam Bankman-Fried associate said to be nearing a plea deal.
How does that help build the case for the prosecutors against Sam Bankman-Fried?
Biden is here to say we will stay with Ukraine until the very end, and that's really a show of support as well for the allies.
Bloomberg, your global business authority.
Welcome back to The Open, everyone. We're 14 minutes into the European trading day. A little bit of pressure across the board with the European stocks 600 down 0.6%. A lot of the markets, a lot of the investors, first of all, looking at the latest Fed comments. We did have an important, actually, official, Mr. Kashkari, saying that the wage growth level is too high for 2% Fed inflation goal. That's significant in terms of their end goal. And, of course, a lot of pressure on trying to figure out how much more demand from China will fuel inflation.
Yeah, and of course the earnings story remains important as well for these markets. We had another flurry of earnings and data coming out just this morning. Drinks maker AB InBev reporting its first volume decline since the early days of the pandemic. And in healthcare, Merck, well, it's pretty downbeat in terms of 2023 projections. Well, Haleon, think of Tums and some of the toothpastes out there, says it will meet its targets. For more, we are joined by Bloomberg senior equity reporter Jan Patrick Barnett. JP, let's start with AB InBev. A beat in terms of the profits, but concerns about volumes declining.
Yeah, very good morning. And that seems the big issue here for investors. The revenue was also a slight miss, and that's a theme that we have seen throughout the earnings season, that companies are struggling a little bit to keep the top line in place where it was before. Margins are getting under pressure as well. AB InBev said that they had a decline in volume, especially in China, where it's still struggling from the COVID restrictions, so that might ease over the coming year. And the company also tried to have an upbeat tone in its outlook, saying it is confident to grow revenue with a mix of volume and pricing power. So far, investors don't seem to be so sure about that. The stock's minus 4%. That speaks a lot for it.
So, JP, it was a miss also for Merck. Do we know what drove the slowdown?
I would point you to their life science business. This is where Merck is manufacturing everything that is related to COVID, so the testing kits and all that kind of stuff. And the demand is softening here, which I guess is a good thing for the world as a whole, as we need less of COVID testing and COVID-related products. But of course, it's not great for Merck's earning. The company also said it's expecting a challenging year and gave a very cryptic line on the outlook, saying it expects slight to slow a solid organic growth, whatever that means. I guess investors also trying to figure out the stock's minus 3%.
Okay, fantastic stuff. Jan Patrick Barnett, thank you very much indeed for breaking down some of the key earnings for us today. Let's stay on the earnings picture and bring back Tobin Deputy Chief Investment Officer Tatiana Pouhan still with us. Tatiana, what is your key takeaway from the earnings so far? How has it informed your view, particularly around which sectors you have a preference for at this stage?
Yeah, I think, the earnings picture shows that very clearly, there are certain sectors, that expect that there will further raises in prices be needed to sort of continue to price in an environment where commodity prices rise and other input prices rise. And I think, especially for cyclicals, I think they are clearly overpriced now. I would be very careful, with those stocks. Because it seems like, those warnings that have come in now from those companies that they need to raise further prices are not correctly priced in, because it's not very clear whether consumers will actually be willing, to continue to accept those increases in prices, or whether they will change their consumption behavior.
So, Tatiana, what does it mean that you want to sell off right now? If you look at some of the consumption patterns going forward, maybe even some of the unemployment, are we in a false sense of security? And if yes, do you want to sell off some of the consumer goods?
Yeah, I clearly think that, to some extent, the picture looks a little bit too bright. And I think, in particular, the resilience of the labor market that we've seen is sort of, giving investors the impression that everything is still all right, despite the picture, where we would expect in an economic recession or even let's say rather an economic cool down. And I think from that perspective, going more towards defensive sectors that should be less sensitive to a cooling down of the economic cycles, consumer spending to go down, especially like tech is super dependent on consumer spending and has been boosted by consumer spending over the last 15 years. So I would be very careful with those sectors that are actually highly sensitive to that factor.
What is your level of concern around market concentration? I know this is something that was front and center for you towards the end of last year. Does the market concentration story, has that started to erode? Is that less of a concern at this point?
No, actually, to the contrary. So in 2020, what we could see was that because there were some concerns about earnings of big tech companies and so on, we could see some decrease in market concentration. But what happened in the beginning of the year, since investors were just in this sort of la-la land, we actually could see that market concentrate again, and in particular, because these large mega-cap tech stocks, they outperformed a lot, and so basically we are back today, where we've been in the beginning of 2022. So we have a huge amount of concentration in the market, and again, once those valuations are reconsidered by investors, we will see a big snapback in valuations. And in 2022, even though it was just a mild decrease in concentration, it resulted in outperformances which were like two-digit numbers of portfolios that were less sensitive to these concentrations and that were more diversified.
Tatjana, thank you so much for joining us. Tatjana Puhan there, Tobam, Deputy Chief Investment Officer. Now, coming up, UniCredit's Andrea Orcel gets a sizable pay bump. Is it high times for European bankers? We'll discuss pay packets in the sector next. That's coming up, and this is Bloomberg.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
World of politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Welcome back to the Open. We are 23 minutes into the European trading day. The losses continue across European equities, down 0.5%. Futures also lower in the US. The S&P E-mini is pointing down by 0.7%, and the bond sell-off continues. Yields up across the US curve. Sovereign debt as well being sold off. Italian BTPs at 4.61 now on the 10-year. That's a move higher by 5 basis points. The dollar is bid, gaining 0.3%, putting pressure, a little bit of pressure on the single currency. 106 on euro dollar, the pound at 1.19. Now, to the banking story, UniCredit have decided to bump CEO Andrea Orcel's target pay, making him one of the highest paid among his peers in the sector. The Italian lender will link Orcel's total package to net revenue costs, capital and profit targets. For more then, let's bring in Bloomberg's banks reporter, Stephen Ahrens. Stephen, why the pay bump then for Orcel at this particular level? 30% is probably a healthy raise.
Yeah, I mean, 30% is something we all like, right? I mean, to be fair, the bank, UniCredit, performed really well last year under him, boosted by rising interest rates in the euro area. Many banks have benefited from that, and the pay bump for Orcel is probably one of the biggest in the industry. There's been talk about his pay, but the performance under him at UniCredit is, I think, the underlying rationale for this.
So does it mean, Stephen, that actually CEO pay in Europe more broadly is going up? And how do they actually compare with Wall Street titans?
Well, yeah, yes to the first question. I think definitely all CEOs probably and all bankers are expecting more pay after a year 2022, which is really good for many European banks. As you may remember, they've been through a decade really of low profitability because of the negative interest rates. Those disappeared last year, and that has given a tremendous boost to many banks who've reported some of the biggest profits in over a decade. So expect pay raises for all. I don't think it's going to be 30% for everyone. But yes, compared to the US, they tend to have bigger pay packages, though, as we know, I mean, Goldman, for example, Solomon has been through a bit of a rough patch recently and has actually gotten a pay cut, if I remember correctly. So, you know, there you go.
It's nice to see we have a lovely full screen there of some of the CEOs, some of the executives of some of the major European banks. And it is pretty good to see the female executive leading the pack in terms of pay, at least in terms of gender pay disparity. That's one positive story. When it comes to Deutsche Bank, they haven't done badly either. What's the story there?
Well, yeah, I mean, especially the traders, they had another year of growth, especially in the rates business. I was just talking about the interest rates and the enormous movements in interest rate last year created a lot of volatility. So the rates traders at Deutsche Bank and across the Wall Street, if you will, had a boom year. Up revenue at Deutsche Bank in that unit was up 400% in the fourth quarter. So they're up for a really big bonus boost. They were told yesterday they're really happy. A few colleagues got a little less, but, you know, pays up.
All right, pay is indeed up. Stephen, thank you so much. Stephen Ahrens in Frankfurt. Coming up, Norway's largest pension company dumps its stake in Adani Green over greenwashing fears, sending chills through the ESG market. We have more on that story next. And of course, if you look at some of the European stocks, they're under pressure following another round of hawkish comments from Fed officials. In fact, if you look at the rate for the 10-year U.S. government debt consolidated above 4%, that was a couple of hours ago, and that's really weighing on stocks overall. So we look at inflation, we look at the trajectory for interest rates.
Yeah, swap markets now in the US pricing in a terminal rate of 5.5%. Hawkish commentary, as you say, from those Fed officials, and we wait that inflation data out of the Eurozone, 10 a.m. UK time. Plenty more coming up. This is Bloomberg.
been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning. And therefore, the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return. And to get a long-term return, putting it into private hands is one way of doing it. But really, the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is U.S. public sector owned that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. European markets open lower amid a jump in global bond yields after more hawkish commentary from Fed officials. Tesla shares tumble after hours as Elon Musk's plan for the EV maker offers no details on new cars, and China warns hedonistic bankers to clean up their acts and toe the Communist Party line. So watch out.
Watch out indeed, yes. Significant ramifications then for the financial sector across China. We have the National People's Congress kicking off on Sunday, watching, of course, for any policy announcements out of that. Let's check in on the markets then. Lower by 0.5% across European equities, and the bond sell-off continues as well. In terms of your sectors, just two in the green at this point. Construction gaining 0.4%, energy gaining 0.2%. At the bottom of the list, technology, a drop there of 1.5%, tying into that yield story then. Yields higher, of course, across the US curve. The 10-year breaking through 4%. We look ahead to the inflation print out of the Eurozone later at around 10 a.m. UK time. Expectations of 8.3% year on year. Of course, there's a surprise increase in inflation out of Germany yesterday. The challenges then for the ECB, and Madame Lagarde speaking today, saying that the fight against inflation is far from over. Francine.
Now, Elon Musk's much-anticipated third master plan for Tesla has fallen flat with investors. Shares slumped in late trading after he failed to offer firm details on the company's next generation of cars. Now, let's get more with our AutoSAR, our Bloomberg Global Autos editor, Craig Trudell. So, Craig, it was it actually lasted for hours. So it's not like this was like a short presentation. It was a lengthy presentation about, the kind of infrastructure they're going to build. They didn't really talk about the cars.
Yeah, almost 4 hours long. It was a late night for me. I do think there was a little bit of detail about what's to come. We'll get into in a little bit about what they had to say about the next drive units that they'll put into their next generation models, but very sparse in terms of details of which models are coming, when they're coming. And that really sort of left investors hanging, right? Because I think they are used to Tesla not shying away from, here's what our sort of product roadmap is like. A few years back, the company was willing to show, a semi and a roadster that, took years to come to market. We still actually have not seen the roadster make a comeback. I think that sort of track record of showing things and then taking years to deliver them maybe makes people a little bit uncomfortable about their unwillingness to not even give a glimpse of what their next generation model is going to look like.
Concern about, maybe the concern then amongst executives of continuing that theme of over-promising and under-delivering. Interesting, correct me if I'm wrong, but they seem to speak more about heat pumps than they did about actual cars. And then they reeled out these executives that many of us had never set eyes on before. What was the kind of message behind that?
I think that was a very clear message of, look at this deep bench we have. I mean, let's be honest, Tesla has a lot to be proud of, and had some really compelling things to share about efficiencies that they've wrung from the organization, their plans to do that going forward, both from a manufacturing and an engineering perspective. And there's of course been a lot of concern about the bench behind Elon Musk. No one's thinking that he's going to abandon Tesla, but of course he is quite distracted with his many other interests. And so it was clear that the company wanted to, sort of get its executive team out there and sort of introduce them to the world. There were more than a dozen people who spent time on stage, and I absolutely think that Musk, while he was willing to share the stage, and that was unusual, it was very different in terms of the style of presentation that we're used to hearing from him. Lots of jokes, lots of big bold claims about the future. These guys. And they were mostly guys who were talking about, the here and now and sort of what they've managed to do in the last few years.
Yeah, and as you say, investors not, at least yesterday, compelled by that lineup. The stock dropping, but also stocks this morning over in China. Rare earth stocks dropping pretty significantly as well on the news. At least the announcement from some of these executives, they're going to be moving away from Chinese rare earths. Another big story as well to continue to follow. Bloomberg's Global Autos editor, Craig Trudell, thank you very much indeed. Now, financing arrangements across the Adani Group have sent a fresh chill through ESG markets as investors wake up to a new risk. Norway's largest pension fund, KLP, recently dumped its entire holding of shares in Adani Green Energy amid concerns that it might inadvertently have helped finance some of the world's most polluting activities. We're joined now by Kieran Aziz, Head of Responsible Investments at KLP Asset Management. Kieran, good morning. Thank you for joining us. So you dumped your holdings because of your concerns about the linkages between Adani Holdings and some of their coal projects in Australia. But many funds, many international funds, many sustainable funds, many ESG index funds continue to hold Adani Green Enterprises. What would your message be to them?
I would say it's important to take a quite concrete assessment of the companies, and what is the purpose of sustainable funds. We had Adani Green in one of our sustainable Nordic Eco-label sustainable fund because it was the only listed company in India which aligned according to the European Union's taxonomy, given that it's 70% in solar and wind. But at the same time, you have to have a holistic approach to ESG. And I have to say, prior to this report and analyze, we had Adani Green on our radar due to concerns for weak governance, and not at least that there have been some controversies related to acquisition of land when it comes to farmers in India. And we have divested 5 other Adani companies. So my message would be that it's important to see, what is the substance here, and given that we have excluded coal from our investments, so it would have been a too high risk to have Adani Green.
Kieran, does the ESG rating industry have a problem? Because a lot of these companies still scored quite high.
I would say these ratings are more an indication rather than giving you a substance here. And based on this case, I think a lot of the rating companies should see, how they measure the ESG ratings. So our approach is that you can't slowly just rely on the ESG ratings. And Sustainalytics have downgraded, but MSCI still has given A to Adani Green, and I think if it lives up to A, that should be a discussable offer after this report.
Yeah, so clearly some question marks for the ratings agencies then around the ESG space. How wide is this? Is Adani Green Enterprises, is it idiosyncratic or is this a broader problem? How widespread is this, and what are the other blind spots potentially for the ESG investing community?
I think it will be first of all, given that it's important that you take a quite concrete assessment, I would say, from company to company. But greenwashing is a real risk which we need to be aware of. And in this case, I think it's quite fair. You want the companies to go towards renewable energy, but at the same time, you need to see within this particular group that they have some interlink which you are indirectly financing coal, and it's not the way we would like to have it. So yeah, and when it comes to companies, I think we want the companies to crystallize their own business in each separate subsidiary. But I think this case also shows that you need to be a little more aware going forward. So this is something we are taking into account.
Kieran, overall, does labeling need to change? Are we now greenwashing because also the usage of fossil fuels? So have things gotten worse in the last 12 months?
I think there are quite good reasons for why investors are pushing companies, and given that every year will be quite vital going forward to make sure that the emissions go down, and it's quite disappointing that if companies are using their creativity to rather maneuver and around strong commitments rather than focusing on actual reduction, and I think we will be quite tough on asking questions related to the integrity of their transition plans, and if they don't have credible strategies, we will hold the companies accountable by divesting if there is a high risk for that.
Okay, so that is the potential future response as well from you, is to continue to divest if you are not satisfied with those credentials. I want to focus a little bit on the US. Two different stories at play there. There's the Inflation Reduction Act, of course, and then there is the fact that the ECG has become the whipping boy of the political right, and we see that with a new bill that's going to end up on the president's desk. He may veto that. He's likely to veto that. What are the opportunities for you and the firm around the Inflation Reduction Act in the US?
I think it's very fair and timely that the US has that policy in place now, because it will lead to that more companies will take that into account. But at the same time, you are seeing that ESG is becoming quite political in the US, and based on our expectation, we will continue to set expectations, and we want the US companies to make sure that they live up to both the Paris Agreement but also the other commitments on basic governance and human rights. So, but it's you can say it's a parallel development in the US, but our job is to make sure to set the right expectations to the companies.
All right, Kieran, thank you so much. Kieran Aziz, their head of responsible investing at Norway's KLP, joining us today. Coming up, SoftBank-owned chip designer ARM has ditched the London Stock Exchange for now as it focuses on its US IPO. We'll get all of the details next, and this is Bloomberg.
On the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite. How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Season continues.
The chips are down.
Earnings coming in fast and thick.
A slew of bank earnings this morning.
Bloomberg breaks the numbers first.
Numbers coming through from Shell.
LVMH numbers are hitting the tape right now.
We had a very good set of numbers in the fourth quarter.
We feel confident with the guidance we've given.
The situation has changed completely.
With exclusive expert analysis.
Europe's most valuable company.
Trending towards the higher end of its historical range.
That can continue.
How do I play this into 2023?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I think there's a great conversation actually going on in the UK markets at this point. And this is not about, it's not about listing rules, it's not about listing regulation. There's an opportunity to implement some of the reforms that the government is looking at, implement some of the reforms that the Capital Markets Industry Task Force is working on that will continue to make London that much more of a competitive and attractive listing destination and financial center.
Okay, that was LSE Group's CEO, David Schwimmer, there speaking to Danny Berger earlier. Now, SoftBank-owned Arm is said to have decided against selling shares on the London Stock Exchange, at least for now. The news deals a blow, of course, to UK politicians who were lobbying furiously the homegrown tech giant ahead of its initial public offering. Let's bring in Bloomberg's Caroline Hepker now for the latest. Caroline, is this a surprise announcement from Arm? You've been on the ground, you've been in Cambridge, the home of this tech giant for the UK. You've been speaking to executives and former founders. Does it really come as a surprise that they're looking to the US instead of the beleaguered UK markets?
No, it's not a surprise. Masayoshi Son, the founder of SoftBank, was always pointing to the fact that he wanted the deep pockets and the markets of the United States. It was British politicians who wanted the homegrown Arm, now SoftBank owned since 2016, to be listed in London. So the disappointment really is for the UK. This is a scoop by Bloomberg. We were speaking to Ruth David about it this morning. The person that I spoke to is one of the co-founders of Arm, who actually took the business public back in 2018. This is Jamie Urquhart. He's deeply involved in training innovators and entrepreneurs here in the UK. So I asked him basically about the backdrop post-Brexit in the UK to creating these sorts of businesses. And he's really despondent, quite disappointed by little continuity, little strategy from the UK government, successive governments. And you had Mr. Schwimmer there speaking about the LSE and who's quite positive about listing here in the UK. But actually, Jamie Urquhart was very disappointed with the missing semiconductor strategy from the UK government and saying that this is part of a theme and that is perhaps the reasoning behind it.
You spoke to him, so let's listen.
There's been very little continuity, there's been very little strategy, and even now we're waiting for the government to come out with a semiconductor strategy. It doesn't take that much to start looking forward and thinking about what you're going to do, but you've got to do it. I think the government are just either unwilling to grasp the nettle, or maybe they've got way too many things to do and aren't thinking about it.
I don't want to beat up on the UK, but it's almost like a no-brainer. If you look at valuations, so there was Ocado recently, Dark Trace Wise. If you look at the valuations, these companies are trading about $60 billion below what's happening in NASDAQ, which reached about $1 trillion in valuation. So what does the UK need to do to attract more IPOs?
Well, we haven't heard anything in terms of response from the UK government or from the Prime Minister's office. Obviously, there will be deep disappointment, but we had 3 Prime Ministers in the space of a year last year, and so the negotiations, even about a secondary listing for ARM in London, were obviously hampered by that. And now, really, the promise is extremely faint that ARM is not ruling out the idea of a secondary listing in London. But yes, it will be disappointing. I do want to add that when I spoke to Jamie Urquhart, I asked him about the Conservative government, but I also asked him about the Labour Party potentially could be in office if they win at the next general election within the next 18 months to 2 years. He was saying, look, it's not off the table that Labour could do better, but he wants to see action. He wants to see a longer-term strategy for innovation, for science and technology in Britain, which successive governments, as I say, have pinned so many hopes on.
Well, maybe this will be the wake-up call. Caroline Hepker, excellent. Thank you very much indeed for bringing us the context to that decision by ARM. The Bloomberg scoop, of course, that they will not be listing, at least for now, in the UK. Let's get the Bloomberg First Word News now with Samuel Etienne. Sam.
Good morning. The Greek Prime Minister says human error probably caused the country's worst rail crash in decades. The government is investigating the head-on collision between a passenger train and freight service which killed at least 43 people and left dozens more injured. The Greek Transport Minister has resigned, while a station master has been arrested. And Bridgewater Associates is embarking on a major overhaul 5 months after founder Ray Dalio stepped down. The world's largest hedge fund firm is capping the size of its flagship fund, ploughing more money into artificial intelligence and machine learning, and expanding in Asia. CEO Nur Bardea says the company must, quote, evolve or die. And the UK is to make the case for greater cooperation with the European Union on financial services. On a visit to Berlin, the UK's Treasury Minister will meet German banking chiefs and executives to discuss a framework for the two sides to work together. Further post-Brexit cooperation on financial services had been on hold due to the Northern Ireland trade dispute. And SpaceX has launched a 4-person crew to the International Space Station, part of the company's ongoing contract with NASA. The astronauts riding inside the Crew Dragon spacecraft lifted off on top of a Falcon 9 rocket just after midnight local time from the Kennedy Space Center in Florida. That's global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg.
Etienne, thank you so much, Samuel Etienne in London. Now, coming up, we'll get the latest out of China's President Xi hints at deepening structural reform ahead of the National People's Congress. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
how do you manage these kind of two different staffing needs, right? And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome back to the Open. We are 53 minutes into the European trading day. Sentiment across the equity markets just turning slightly more positive. You're still off by about 0.1% across the benchmark, but it's a slightly brighter picture, or at least a less dire picture than at the start of the session. Futures in the US still pointing lower by about 0.5%, and there is still that sell-off in the bond markets, but again, less pronounced now. 53 minutes into the session this Thursday. Francine.
Now, the economy, of course, will be in focus as Chinese lawmakers meet in Beijing next week for their first gathering since abruptly scraping strict COVID-0 policies. Well, Bloomberg Greater China Senior Executive Editor John Liu tells us what to expect.
It's time again for the once-a-year full session of China's parliament, the National People's Congress. Thousands of delegates will descend on Beijing to review and approve the country's plans for the coming year. But this won't be the sort of legislative debate that you might see in Washington, D.C. All the plans and targets are formulated well in advance, behind closed doors, and there is no uncertainty about if the NPC will give its blessing. Instead, the reason this event is so closely followed is because it is here that China will unveil its 2023 plans to the world. One closely watched detail will be the 2023 growth target. Chinese officials have been debating whether to set that mark at 5%. That would be a substantial acceleration from the 3% that China grew in 2022, and would suggest that Beijing is getting ready to provide more pro-growth policies this year. Also on the spotlight will be China's relationship with the United States and the rest of the world. Newly appointed Foreign Minister Qin Gang will be taking questions from reporters at the NPC. With tensions bubbling over Russia, Taiwan, the balloon, whatever he says will be closely followed. This year's NPC will also mark the end of a 5-year term for China's cabinet. So we are ready to get a new premier, new vice premiers, a new finance minister, and a new central bank governor. While Li Qiang, an ally of Chinese President Xi Jinping, is expected to become premier, it's much more of a question who will be put in charge of the finance ministry and the central bank. This is John Liu in Beijing for Bloomberg News.
Bloomberg's Greater China Senior Executive Editor John Liu there on the start of the National People's Congress. It will kick off on Sunday, and some big changes as he flagged. Meanwhile, we're seeing lines through from, of course, the European Central Bank and Madame Lagarde, Francine.
Yeah, it was really interesting. So she actually spoke to Spanish TV this morning. It's interesting, first of all, to see what media she does, because usually it's a specific message for a specific country, especially on the back of that very high inflation figure. And she basically said, look, the ECB rates hikes may need to continue beyond March. So she's telegraphed well and truly numerous times that we have 50 basis point hike in March, but then there seems to be a lot more going on, especially after that, inflation print from Spain and France that was much higher than expected.
Yeah, and how much concern is there about the sovereign parts of the Eurozone, of course, as rate hikes are increasingly priced in? Goldman Sachs raising their expectations around the terminal rate from the ECB to above 3.5%. Yields on, I'm just looking at some of the sovereigns, the benchmark, the BTP benchmark 459, that's moved higher by 2 basis points. And again, the 2-year over in Germany, not of course a peripheral, but the benchmark, that has seen about a 70 basis point move higher as well. Euro dollar currently at 106. Madame Lagarde sees no signs of recession on the horizon for the Eurozone, at least for now.
Yeah, and investors now see that deposit rate being lifted to a peak of 4%. So we'll ask Lorenzo Bini-Smaghi, former, of course, the ECB Governing Council member. In the next hour, we speak to him exclusively. He's also chairman of Société Générale. So it's a conversation on banking, but also European inflation. This is Bloomberg.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority. A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Global bond yields jump after more hawkish commentary from Fed officials. Investors now waiting on euro area inflation due in 1 hour from now. Also on the program, we discuss a macro outlook in our exclusive interview with Lorenzo Benismaghi, the chairman of Société Générale. Plus, later this hour in Bloomberg UK, we'll also have more of our interview with the chief executive of the LSE Group. It plans to buy back £750 million worth of shares from a consortium, including Blackstone. Now, first thing is first, so let's check on the markets. We're seeing a little bit of pressure across the board after that hawkish commentary from Fed officials. Now, this is also on the back of rising assumptions that actually demand in China will grow significantly, fueling further inflation because of the reopening. So stock markets worldwide extending some of the losses today. That was really started yesterday. I'm looking at the U.S. 10-year Treasury bonds topping 4% for the first time since November. Again, a sign that the Fed's warning of higher for longer interest rates finally sinking in. S&P futures down 0.5%, and then the German 2-year yield at 3.218. There was also a fantastic interview that Christine Lagarde, president of the ECB, just gave to a Spanish television where she talks about the need, first of all, reiterating that we're going to get a 50 basis point hike in March, but also the need possibly to raise rates further. This is a picture across the board. Look, for the moment, the FTSE's unchanged, but we are seeing pressure on the DAX and the FTSE maybe around 0.4% lower. So let's get back to our Bloomberg, of course, main story, and that is inflation across the world. The focus on how much some of these higher interest rates may go up in the U.S. and the Eurozone. We look at the swap markets as well. Let's also get to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The Greek Prime Minister says human error probably caused the country's worst rail crash in decades. The government is investigating the head-on collision between a passenger train and a freight service, which killed at least 43 people and left dozens more injured. The Greek Transport Minister has resigned, while a station master has been arrested. Now, the UK is to make the case for greater cooperation with the European Union on financial services. On a visit to Berlin, Trade Minister Andrew Griffith will meet German banking chiefs and executives to discuss a framework for the two sides to work together. Further, post-Brexit cooperation on financial services had been on hold due to the Northern Ireland trade dispute. Bridgewater Associates is embarking on a major overhaul 5 months after founder Ray Dalio stepped down. The world's largest hedge fund firm is capping the size of its flagship fund, ploughing more money into artificial artificial intelligence and machine learning and expanding in Asia. The company's CEO says Bridgewater must, quote, evolve or die. SpaceX has launched a 4-person crew to the International Space Station, part of the company's ongoing contract with NASA. The astronauts are riding inside the Crew Dragon spacecraft, lifted off on top of a Falcon 9 rocket just after midnight local time from the Kennedy Space Center in Florida. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Thank you so much, Leanne. Now, ECB President Christine Lagarde says rate hikes may need to continue beyond a planned half-point move in 2 weeks' time. Now, it comes as Fed officials open the door to higher rates to curb high U.S. inflation that's showing few signs of abating. Now, a bit of a curiosity, I think there's also Christine Lagarde still live on Spanish TV where they're analyzing her signature on some of the euro notes. Now, for more on all of this, we will not analyze her signature right now. Bailey Wakefield, multi-asset portfolio manager at Aviva Investor Global Services. Thank you for joining us. Bailey, when you look at the inflation trajectory for the Eurozone and the European Central Bank, how tricky is it going to be for them to raise rates significantly without killing off the economy?
Well, it was expected that inflation would fall in Europe in February, but considering that we've seen 3 regional upside surprises or numbers holding steady, it could be that we have another upside surprise in sort of regionally. We've seen surprises more from the price of food and energy cost pressures. We're yet to see signs of easing from price pressures. That's definitely something that they're going to have to keep a close eye on. And investors are going to look closely at the data points that we're seeing coming out today in the ECB minutes for clues as to how the pace of tightening might progress beyond the 50 bips that's priced in for March. But given those surprises and potentially another surprise today, further significant steps might be necessary. And it's a good reminder that the inflation path down can be quite choppy.
So what does it mean for, if you look at some of the individual stocks or certainly industries, there's been so many job layoffs. Does it reflect the deteriorating conditions in Europe, or is it just cost cutting to make sure that they can give back to shareholder returns?
I think it's a bit of both. I mean, you're going to have some cost-cutting measures. I think investors were very much aware that cost-cutting measures were going to have to be in the picture here. And with some of the results, we are seeing some volatility in terms of some of the returns that were given back to shareholders as well. So, for example, in the basic resources sector, we have seen some differences in dividends, which should have been somewhat expected given that they're targeted towards the payout policies that the companies are aligned to. But still, because of the change in price of commodities, which of course feed into to inflation, we are seeing different payouts there. So that's something that investors are keeping a close eye on.
Bailey, every week we have an MLive question that we ask all of our markets guests. Do you expect, and this is the one for this week, do you expect actively managed or passively mutual funds to outperform this year?
I definitely side on active. I think these environments are perfect for active funds to take advantage of some of the underlying themes that we're seeing in markets at the moment. We are definitely seeing some choppiness in markets depending on what the data points we're seeing released at any given kind of point in time or any given day. But being able to take active positions means that you can take advantage of those underlying themes that are cropping up in markets at the moment.
All right, Bailey, thanks so much. Bailey Wakefield, multi-asset portfolio manager at Aviva Investors Global Services. Now, coming up, Societe Generale Chair Lorenzo Binismaghi on the outlook for the European economy on the back of hotter-than-expected inflation readings. That interview is up next, and this is Bloomberg.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody is talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now, Société Générale says the markets are willing to price in more ECB rate hikes if data disappoints next month. That follows an unexpected deceleration in German inflation, further complicating the central bank's task after overshoots this week in other parts of the continent. Well, we're now very pleased to be joined exclusively by the Société Générale chair, Lorenzo Binismaghi, one of, I guess, the few bankers in charge of a banking giant who also has first-hand monetary policy experience. So thank you, Mr. Binismaghi, for joining us on Bloomberg. When you look at the problem that the Fed has, the Bank of England and the ECB with targeting inflation, do they have to really crush economies to make sure that they hit their targets?
Well, they're not crushing the economy because the problem arises from the fact that the economy is quite resilient. We haven't seen a recession in spite of forecasts of recessions. Right. So the economy is stronger than expected, which means that inflation is higher than expected, and probably means that interest rates have to be higher for longer, and there's no free lunch. I mean, in order to bring inflation down, there's no historical experience of inflation coming down without some cost to be paid. You have to be careful to calibrate well your instruments, but in the end, you can't give up. Right now.
But why have we not seen an uglier economy right now? So is there a lag time of the monetary policy that was put in place in 2022, or has the model and structure of our economies fundamentally changed?
Well, first, certainly monetary policy operates with lags, 1.5 to 2 years, so we have to see the impact. And probably the models that central banks use know that, so they have this. But our economies have been more resilient. If I think about Europe, with the increase in interest rates, the increase in energy prices, companies, households have used their savings. So we have been more resilient. How long will it last? That's to see. I think the key issue going forward is the combination of the various policies. Monetary policy is going to be tighter. No. Fiscal policy probably is going to be tighter because we have to come down from the deficits. And the other issue that nobody really talks is prudential, supervisory policy on banks. And this is also getting tighter because supervisors are getting concerned about banks lending too much and so forth. So the combination of all this may lead to a policy mix which is very restrictive. Yeah. And so we may reach 2% maybe earlier than expected, but the impact on the economy may be quite negative.
So what kind of an economy? So you think we could reach 2% inflation target earlier, but this wouldn't be, would it be as close as 2024 in Europe? And what, a full recession for most countries, or how do you see that panning out?
Well, that's difficult, but I think it's difficult to forecast, but I think it's going to be difficult to get to 2% within 18 to 24 months without a major slowdown in the economy. And that's part of the adjustment process. On the other hand, if we give up, And let's remember, I mean, if you go back to history, Paul Volcker, which was a big inflation killer, he got it wrong the first time. He started to cut rates too soon. Then he had to increase rates again to up to 20%, the Fed fund rate in 1980. And this really crashed the economy. So we can't miss if we don't do it wrong. If we give up too early, then the price will be much higher.
When do you see peak rates actually in Europe? And again, I know it's a difficult question, but does it have to be in September? So do you have to just hike aggressively and then wait and see? Is that the better option, better way to look at it?
My impression is once the economy slows down, it's going to be very difficult for central banks to continue increase rates. They have to say that they will do it. They have to talk very toughly, to be hawkish. But once you see strong signs of recession with unemployment going up, it's going to be more difficult. So I think this is why they are trying to catch up rapidly. So in the spring, until June, I think they will continue to raise rates. But after that, I think they will rather pause.
What are your clients telling you? So when you look at the first couple of months of this year, are they worried about inflationary pressures? You know, how's lending going?
Well, actually, there are no signs of major problems. I mean, our clients in general, and it's not a good sample because we tend to have the good clients of, it's the rest of the economy, which maybe is less supported by the financial system, who gets into trouble, that have problems. But our clients actually are doing relatively well. They have restructured. They are more cautious, of course, but they are not concerned about the future. The problem is the rest of the economy, which has to still do the restructuring. And once the consumption will start to decline because consumers will have to adapt to higher energy prices and will not have the savings accumulated from the past, at that point, we will see a sharper slowdown.
But is that accompanied also with the employment, a lot of unemployment, which we haven't seen for the moment? We have a very tight labor market.
That's a surprise. I mean, the economy have been doing relatively well, been quite resilient, especially in Europe. We didn't expect that. On the other hand, this shows that bringing down inflation is going to be easy. And we haven't had inflation for 15 years, so nobody really knows how far you need to put pressure on the economy to bring inflation down.
Rising interest rates is good for banks. You should be making a lot of money on the back of it. Do you feel like Société Générale can really reap the full rewards, or is it held back by, I guess, French rules?
Well, I mean, the French market is not easy. At least in the first year, at the beginning of the rate increase, given that we have fixed rates on the lending side, we have the opportunity, of course, of passing on to the clients much more slowly than in other parts of the world, in countries like Spain or Northern Europe. So we keep the risk, we keep the interest rate risk, which banks are expected to manage it better than clients. So in fact, these credits are sounder, have a lower credit risk. So we have we manage ourselves the interest rate risk, but it is sounder from the solidity of from the point of view of the solidity of the economy.
Which is a good thing,
Yes, it's a good thing because you have to look at the long term.
Yeah.
In the short term, they take the benefit, but in the long term, we have less risks, and we can absorb it. And then when rates will come down, we will continue to have benefits for a longer period of time.
All right, Mr. Binismaghi, Lorenzo Binismaghi, Soc Gen, Chairman, stays with us. We'll talk a lot more about the banking world and, of course, possibly banking consolidation. I feel like I ask Lorenzo every time he comes on whether there'll be cross-border M&A. We'll have plenty more with Lorenzo Binismaghi shortly. This is Bloomberg.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Coverage begins next week on Bloomberg.
thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Societe Generale Chair Lorenzo Benismaghi is still with us. Lorenzo, thank you so much for sticking around. We talked about inflation, the right path forward. Talk to me a bit about Societe Generale. So you have an incoming chief executive. Are you expecting the strategy to change, or what will this bank become in the next 3 to 4 years?
Well, we'll wait the new CEO and we'll discuss with him. Clearly, there are some issues which are clear. We have a restructuring of the French retail, the merger between the two, which is going to be completed. The restructuring of the investment bank has been processing. We have a lot of new avenues, the merger between LeasePlan and ALD, the development of the online bank, Boursorama. So many issues on the plate for the new CEO, and we look forward to develop with him the new process going forward.
Do you think your bank will feel a lot of pressure to give more back to shareholders through either share buybacks or dividends?
Well, I mean, that's a very interesting issue. I think there's a lot of pressure doing that. I think banks may have different strategies around the world. Yeah. Some banks may think that, in the end, the market is mainly local. It's what it is. It doesn't grow much. So what should I do with the additional capital? I give it back to shareholders. We as a bank, we think we have many businesses where we can compete with the American banks, with the other European banks. We can grow. So we want to use the capital more efficiently possible in order to get more businesses and to make the bank more profitable. So it's a different strategy from other banks, but we need to do the buybacks as in line with the dividend policy, but we need also to grow. I think that's what the European economy needs. It needs European banks that can support European companies to compete in the global economy, and that's our role, I think, to support this.
Organically or through cross-border acquisitions?
Right now, it's organic because the banking system is in a process of restructuring, improving profitability. Then we will see. I think that depends on the regulators also to make it easier for banks to make mergers. Maybe the market will put pressure on that, but right now, I think we have to look at our own restructuring and improving our profitability.
Lorenzo, every time I speak to a banking executive, tattooed to my brain is ask about bonuses and ask about job cuts. I mean, this is one of the things that people want to know and want to read about. How's the bonus pool looking at? So do you feel like you need to increase people's pay to retain them?
There's a competition for talent, as we say. It depends year on year. I think Societe Generale last year have done a very good year. So I think we need to incentivize people to do a good job. There is a balance to be kept between the different levels. I think French banks tend to be quite reasonable, and there is pressure from the the society, from investors, not to be excessive. So I think you can find a good balancing act to incentivize and to be fair.
And what about job cuts? I mean, one of the things, again, that we're trying to figure out from bank executives, but actually, chief executives in general, does it feel good right now from where you're sitting in terms of the economy, and will that lead to job cuts?
I think job cuts are not necessarily the best instrument for a cyclical process. For structural changes, I mean, nobody goes to bank branches anymore. So this is a structural change, and you need to adapt. And this may lead to re-educating people, and partly to let people move on and reorganize the bank. But again, I think there is a difference of philosophy between continental banks, I think, and U.S. banks. I mean, I don't think that we need to. I mean, the instrument of adjustment is not labor. It's maybe bonuses, but you have to keep the good people over time.
What are you most, I mean, if not excited, like I don't know what to do with ChatGPT, so we have many Wall Street banks that banned it. What will the relationship be between AI through ChatGPT and a lot of the banks?
No, AI is fundamental on many issues that can be simplified. If you think about compliance issues, risk management. So there is a lot that we can learn and improve. You have to keep the human being on top. I think that's the challenge.
Lorenzo, thank you so much for joining us today. Lorenzo Vinismaghi, the chair there at Societe Generale. Now, coming up, we take a deep dive into the biggest story in British politics this week. Chatham House Director and Chief Executive Bronwyn Maddox joins us to discuss the Windsor Framework. That's coming up shortly, and this is Bloomberg.
On the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
The moment news breaks, no one covers the world like Bloomberg.
6 people have died from these latest quakes, adding to the 41,000 plus people who've died in those major quakes 2 weeks ago.
A top Sam Bankman-Fried associate said to be nearing a plea deal.
How does that help build the case for the prosecutors against Sam Bankman-Fried?
Biden is here to say we will stay with Ukraine until the very end, and that's really a show of support as well for the allies.
Bloomberg, your global business authority. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Coverage begins next week on Bloomberg.
Good morning, everyone, and welcome to Bloomberg UK, a news show with a special focus on the biggest challenges facing the British government, the economy, financial services and markets. I'm Francine Lacqua here in London. Now, on the show this week, the UK is pushing for closer financial services links with the European Union following the breakthrough deal on Northern Ireland, but it's not yet clear if the agreement has enough political support. Also on the program, could the Brexit deal put UK assets on the long road to recovery? We'll discuss what that means for investors and more of our interview with the chief executive of the LSE Group. It plans to buy back £750 million worth of shares from a consortium, including Blackstone. Now, the British Prime Minister Rishi Sunak dubbed it as a decisive breakthrough as he and his EU counterpart, Ursula von der Leyen, unveiled a post-Brexit deal on Northern Ireland trade agreements. Well, Leanne Gerrans is here to walk us through the deal and what's ahead. Hi, Leanne.
Francine, hello to you. So this is a breakthrough deal between the UK and the EU, really aimed at tackling one of the stickiest post-Brexit issues, Francine. That's trading rules for Northern Ireland. It's called the Windsor Framework and will reduce checks on goods travelling from Britain to Northern Ireland through a system of a green lane for goods that will stay in the region and a red lane for goods which will travel onwards to the EU, just seen on the map here. It also introduces a new mechanism. Now that's called the Stormont Break, which will allow the Northern Irish Assembly to challenge changes to certain EU rules. This is meant to give politicians a say over how European laws do apply to them. European Commission President Ursula von der Leyen described the deal as extraordinary and said it would ensure a long-lasting solution for all the parties involved. Meanwhile, Prime Minister Rishi Sunak says the agreement would protect Northern Ireland's place in the Union and deliver smooth-flowing trade. Now, one of the key goals is getting Northern Ireland's DUP to approve the new Brexit deal, and that's to restore power sharing in the region. Yesterday, the Democratic Unionist Party's chief whip, that's Sammy Wilson, said the party will not give a knee-jerk response. This is the next piece in the puzzle for Rishi Sunak. He needs to ensure his Windsor framework is successful, and the goal is to see the Stormont Assembly up and running in time for the 25th anniversary of the Good Friday Peace Agreement next month. So, Francine, we are all waiting for the DUP to give their verdict on this new and latest deal.
Leanne, thank you so much. Some fabulous reporting there on exactly what we found out this week, Leanne Gerrans. Now, for more, let's also bring Bronwyn Maddox, Director and Chief Executive of Chatham House. Bronwyn, thank you for joining us. Are you optimistic that it's plain smooth ahead, it's plain sailing ahead? Are we going to get this through?
Well, it depends what you mean by get it through. Can Rishi Sunak get it through Parliament? Yes. Labour, the opposition, has already said, yes, it will support this. He has enough Conservative MPs that together with Labour can get this through. The question is how many of his own Conservative MPs want to cause trouble and whether or not the DUP comes along. That matters not so much for getting this through Parliament, but for whether the Assembly, which we were just hearing about, the Assembly in Northern Ireland, that power sharing agreement that is Assembly that is at the heart of the Good Friday Agreement of 25 years ago, whether that can get up and running, because that is the government of Northern Ireland, and we've had periods, up to about 3 years when the power sharing failed, and the civil servants were trying to run it. But they have been saying quite plaintively, look, there is a limit. There are a point when there's real political decisions, that have to be taken by politicians. How much to spend on this or that, and so it really matters, to get that up and running. But it's not the same thing as the whole legislation.
But do you think, first of all, that the DUP will accept Rishi Sunak's Brexit deal?
They haven't said no immediately, and that has been what they've tended to say about all kinds of things. So this is, in a sense, good news. The DUP isn't any longer one entity. There are clearly very different voices in there, and there's a lot of disagreement going on. Do I think they'll all accept it? No. Do I think they'll accept it enough to get back and agree to take part in Northern Ireland government again? Possibly, but they are an unpredictable force in politics. They've sometimes been dubbed the party of no, because they can see their objections to things more easily than they can see, a compromised way through. But there are people there, Peter Robinson within there, saying, look at how bad it might be if we don't accept this. So there's a big argument going on. I wouldn't put 10 cents on it either way, I'm afraid.
I know, and it's difficult to speculate at the moment. We know that they're, if not casting doubt, certainly saying that they're still analyzing the Brexit deal and won't make a knee-jerk reaction. But with every day that passes, is it more likely that they accept the deal? Bronwyn, I don't know if you can still hear me or if you're still there. The question was, I'm
still there. It cut out. Go on.
Yeah, the main unionist party in Northern Ireland said they will not make a knee-jerk decision on whether to accept it. With each day that passes, is it more likely that they accept it, or is it wishful thinking?
I think it's more likely that they accept it with each day that passes. As I said, their main reaction has tended to be in the past when they don't like something to say so immediately. So I think they would like to find a way through, and they can see the amount of support there is for this, including among Northern Ireland people and businesses. But they're a very unpredictable political force.
Can
I would say with each year that passes, we're not.
Right.
Yeah, I think he should press ahead. Their electorate is getting, their voters are getting much more nuanced, much more complex. Many people who were DUP voters, die-hard DUP voters years ago, now saying, look, we trade, I'm a small businessman, I'm a farmer, I trade across the border, I need that border to the south to work, I need the border with the UK mainland to work, or there to be very little obstacle there. So I want something like this to go ahead. So I think they will get pressure from their voters. And I think Rishi Sunak, yes, should push ahead.
Thank you so much for joining us, Director and Chief Executive of Chatham House, Bronwyn Maddox. Now, we'll have plenty more, of course, on the UK show. The UK and the EU finally agreeing on a post-Brexit trade deal, although for the moment it's called a framework. What does this mean for investors? Where does it leave British assets? We'll discuss that next. And this is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacroix here in London. Now, we're just getting some breaking news out of the BOE. This is the publication of a decision maker panel survey. And they say, this is according to the BOE, it's a BOE survey saying that UK firms expect an average wage to rise 5.7% in coming years. Now, actually, in the coming years, in the next 12 months, that seems definitely below what we have at the moment. And then we also have a little bit more, of course, insight into inflation expectations. So inflation expectations for the same firms that the BOE has surveyed, they expect it to be 5.9% in 1 year and then 3.4% inflation in 3 years. Now, the leaders of the UK and the EU both hailed last week's post-Brexit trade deal as a chance to reset trade relations between the two sides. But for investors in British assets, the repair work is only just beginning. Well, joining us now is Bloomberg's John Stepek, who writes our Money Distilled newsletter. It's fantastic, so I urge everyone to go and have a look. And then also Lucia Yevtopoulou, who covers the asset management beat. So thank you both for joining us. John, I love really reading your newsletter on house prices, on what this means for UK assets. First of all, how long does it take for, I guess, the encouraging news about better ties with Europe to filter through UK assets?
I mean, that's a good question. The things we don't know.
Hard question.
It's a very hard question. Exactly. If I knew the answer to that, I'd go on a private island somewhere. No, but I think the thing to understand is that UK assets have been shunned by global investors for the best part of 7 years now. And while you can argue about the economic impact of Brexit, I think you'd have to be in denial not to admit that Brexit is, has kind of created this geopolitical discount on UK assets. Now, the main thing about the deal this week is that regardless of whether it goes through or not, we've got we've got Rishi Sunak and Ursula talking to each other like adults. So the UK and the EU are no longer basically trying to stab each other in the back. And that kind of sign of reconciliation should hopefully remove some of the geopolitical discount that we've had hanging over us since 2016.
Yeah. I mean, I have a lot of follow-up questions to that. But first, Lucia, where do you see the best value? Or actually, where do you see the most unloved UK assets that could suddenly be getting a lot of interest?
I mean, UK equities have been shunned for the past 7 years. UK equity funds have seen billions and billions of outflows since the Brexit referendum. And the sentiment has started to turn, but it's not certain it's because of the Brexit deal. It's mainly because they're cheap. Some people say, okay, they have a 5 to 7 year upside. So some investors have started to go back into them.
And this is what? This is like, is it asset managers? Is the UK market still seen as the kind of the beacon of success?
It depends on who you speak to, but some of the very big asset managers like Schroders, for example, and Fidelity International say they now like UK equities a bit more. Fidelity International say they're overweight, then they see a longer term upside. Schroders CIO called it in a statement to us a safe harbor for now. So I think there's a long way to go, but something might be changing.
Yeah, and politically, I guess, some of the questions that we had is, we've had 3 prime ministers in 12 months. There's still a lot of question marks on whether Boris Johnson comes back. We have a lot of question marks of what Labour would do with some kind of deal. So what are the questions that you're hearing from managers or investors?
Well, I think the thing is that Rishi Sunak is seen as a safe pair of hands.
Yeah. But we don't know how long he stays.
Well, we don't know how long he stays, but the thing is, if Keir takes over from Rishi come the next election, so the next UK election has got to be held before January 2025. Chances are it'll be late 2024. Now, if you think about what could happen at that point, either the Conservatives stay under Rishi Sunak, most likely, or Labour kind of wins under Keir Starmer. Now, the thing is, Keir Starmer has gone a long way to rehabilitating the Labour Party following the Corbyn regime. And I think that the other thing to kind of point out is that Keir Starmer does not want Brexit to be a problem under his watch. Yeah. So if he does end up running the next government, he doesn't want to have to continue dealing with this. So I think that most asset managers would see that we're now in a point where you can assume that the future path is going to be less chaotic than it has been.
I mean, I'm self-crowning you like, political analyst on the program. I don't know how many people, I get asked quite a lot, like, what happens to Boris Johnson? Does a Boris Johnson comeback become less likely because of the Rishi Sunak Brexit deal?
I think almost certainly. I mean, I struggle to see, we're past the point where it's such any Conservative MP who wants to get elected next year, have any chance of holding on to their job, has to understand that the majority of the population, whether they voted Remain or Leave, is now, at the very least, bored of the Brexit question. They want everyone to get over it.
Never.
Well, exactly. I mean, the fact that Steve Baker, who was quite a prominent kind of Brexiteer, welcomed the deal kind of shows you that I think the calculus has changed. And I honestly think that if Boris Johnson was to try and mount some sort of comeback, it would largely be greeted with, resounding, no, they wouldn't be keen.
They would be keen. Look, how difficult is it, first of all, to price the Brexit discount? And you wrote a wonderful piece this week that basically says, look, this Brexit deal puts disliked UK assets on a long road to recovery. I mean, what's a long road?
I mean, it's very hard for me to say, and I would be in a different profession potentially if I could make these guesses, but 5 to 7 years is like a time frame that we're hearing from investors. Now, whether this has started because of the Brexit deal again, it's not 100%. It kind of started a bit before, but definitely some certainty doesn't harm.
Where do you think there's going to be the most interest? I don't know whether it's too soon to say whether it's Indian investors that say, look, now's a good time to get back. We tried to speak to the people in charge of attracting foreign direct investment to this country, and there's still a lot of question marks of who will have the most appetite for UK assets.
I think maybe a lot of people are still sitting on the fence because the Brexit risk has been priced in, but there are still worries about the upcoming election. There are problems with the union in Scotland. And I think some institutional investors might have started to look back into it, but specifically with locations and services, it's a bit early to tell.
So John Stepek is now really going to depress us, talking about house prices. So John, UK house prices slid at the sharpest annual pace since 2012. Is that on mortgages, or is that really just on recessionary risk?
Oh, that's mortgages. Okay. I mean, I don't think people kind of struggle to wrap their heads around this, but a house is an asset like any other. I mean, you can almost price it like you would price a bond. It generates an income, and when interest rates go up, the yield you require from that goes up, and therefore the capital value of the house goes down. If you want to put it in strict financial market terms, that's basically what it is. So
I would love to see you negotiating with Foxtons. Can we just pause for 1 second? Should we just bring, every time you're looking at a place, bring John Stepek with you?
I wish. But I mean, the good news is that mortgage rates are actually much lower than they were in October. They've come down since then. But even if you assume that they stay at current levels, you're talking about you can maybe get a 5-year fix for about 3.94% just now. A year ago, you could get that for about 2%. Yeah. There's no way that can't have an impact on house prices. Now, the good news, or rather the fingers crossed scenario, is that house prices adjust and become more affordable, largely in real terms. So because of inflation, house prices are actually, in real terms, down about 11% from their peak in August, and they're down about 4% in nominal terms. What you ideally want is for about half of it to be real terms and half of it to be nominal, because a 20% fall in nominal terms would only take us back to pre-pandemic levels.
Right.
So at that point, you're probably talking about there's a very small number of people who would be suffering from negative equity. It wouldn't be terribly catastrophic from an economic point of view. But if it falls by, say, kind of 30% in real terms, that means that first-time buyers can get on the ladder. You kind of diffuse some of the political toxicity of the housing market. And actually, that would be a good outcome. A good outcome, yeah.
John, thank you so much. We have an industry secret. I think John Stepek's DMs are open on Twitter, so if you're buying a house, just DM with mortgage advice. You're welcome, John. John Stepek and Lucia Giftopoulou. Now, coming up, chip designer ARM decides against selling shares in London. We'll bring you our interview with the London Stock Exchange Group Chief Executive Officer. He's David Schwimmer. That's coming up next, and this is Bloomberg.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody is talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
We regularly work with the UK government. I think it's a good level of cooperation. We work closely with stakeholders in this market. We work closely with governments and regulators in other markets as well, whether that's in France, in the US, in Asia. So it's a core part of what we do. And we have a significant regulatory footprint. So it's just part of a core competency for LSEG.
And of course, one thing the government was trying to do in terms of strengthening the finances of the City of London specifically was trying to court an ARM listing in London. And of course, ARM used to be listed in London in about 2016 before it was acquired by SoftBank. But we learned today that SoftBank is going to be going for a US listing. How big of a blow is this, David, to have the homegrown tech company not come back home?
So ARM is a great British company. London continues to be a fantastic listing venue and the most international listing venue. I'm not going to comment on any specific or the latest speculation on where it's going to list. But I think there's a great conversation actually going on in the UK markets at this point. And this is not about, it's not about listing rules. It's not about listing regulation. There's an opportunity to implement some of the reforms that the government is looking at, implement some of the reforms that the Capital Markets Industry Task Force is working on that will continue to make London that much more of a competitive and attractive listing destination and financial center.
So David, David, quickly then, do you think that, are you still holding out hope that ARM might list in London?
As I said, I'm not going to speculate on, this has been an ongoing saga for a couple of years, I'm not going to speculate on the latest.
That was David Schwimmer, the Chief Executive Officer of the London Stock Exchange Group, speaking to our Danny Berger. Now, SoftBank-owned ARM is said to have decided against selling shares on the London Stock Exchange. We all know that. We were just hearing from the LSE Group Chief Executive. Where does this leave politicians? Where does it leave tech giants in general? Well, we have one person who's been following this from the very beginning, Bloomberg's Caroline Hebker, recently speaking to ARM's co-founder, Jamie Urquhart. Caroline joins us now. Good morning. Thank you so much for joining us. I mean, you did some great reporting. You went on the ground, of course, in Oxford as well. What prompted this decision?
Well, this is the issue. Perhaps frustration. Bloomberg's Ruth David actually broke the story around the issue that there won't be a listing in London, we don't think, according to Bloomberg sources. Is it frustration? 3 prime ministers in the space of a year. We know that the government has been lobbying ARM to list in the UK, and yet there has been political uncertainty. There has been, a dormant IPO market effectively in London. So the backdrop has not been good. So I was speaking to one of the co-founders of ARM, actually somebody who took the business public back in 1998. He then became the COO. He's deeply involved in technology, in electronics, and he was actually really pretty scathing about how the government has handled matters and the backdrop for innovative businesses in Britain.
There's been very little continuity, there's been very little strategy, and even now we're waiting for the government to come out with a semiconductor strategy. It doesn't take that much to start looking forward and thinking about what you're going to do, but you've got to do it. I think the government are just either unwilling to grasp the nettle, or maybe they've got way too many things to do and aren't thinking about it.
So how much of this, Caroline, is a political situation? How much of it is just actually just NASDAQ offers better valuations? It's a bigger market. It has more investors.
Yeah, absolutely. Masayoshi-son has always been very focused on the US listing and has made that very clear that the investor base, the pool of money and markets in the US is very attractive. I think that it would have been a big coup for Rishi Sunak and the government had they managed to get the listing here in London, but now actually a secondary listing looks in great doubt.
Yeah, Caroline, thank you so much for the great reporting, Caroline Hepker there. Now, be sure, of course, to subscribe also to Bloomberg's In the City podcast that I host along David Merritt on Apple Podcasts, Spotify, or wherever you get your podcasts. We have a new art going with, of course, the podcast, and today's episode is about football. This is Bloomberg. Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we're seeing more and more people say, I have to worry about me as a person, I have to worry about my family, I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
what we're seeing in the Eurozone is more of an overheating in terms of inflation pressures.
Equities are not pricing in the risks of a tighter Fed, a tighter ECB that are pushing rates further into restrictive territory.
We've had negative real interest rates in Europe since the financial crisis, and it's time to straighten that out so that investment doesn't get misallocated and so the economy can grow in a healthy way. That's a good outcome here.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. The latest inflation numbers for the euro area are just crossing. The data likely to be the crucial factor in determining what the ECB does next on interest rates. Elon Musk's master plan for Tesla, it falls flat with investors. He fails to offer any firm details on the company's next generation of electric vehicles. And this could feed the worst fears of crypto watchdogs. Silvergate Capital warns that it needs time to figure out just how badly it was hurt by last year's crypto rounds. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Matt Miller, of course, in New York. Anna Edwards is off. We're going to check the markets, of course, on the inflation data. But Matt, you're going to start with what's been happening in the US.
Yeah, quick look at futures because we are down after a down day on the S&P and the cash trade yesterday. The Dow actually eked out a gain, but the Dow and the NASDAQ were down. S&P futures now off about 2/3 of 1%, as you can see here. And the U.S. 10-year yield remains above 4%. Right now, it's up 5 basis points to 4.0418. So it continues to rise, and it's very likely that the European inflation data you're about to talk to us about is really adding upward pressure on these yields. The U.S. dollar index right now about 0.25% at 1251.79. So itself inching ever higher here, as is NYMEX crude, 78.06. We're up $2 compared to where we were yesterday, 37 cents on the close. So that continues to rise as well on the China reopening after we got positive data there. Tom, what do you see in terms of that inflation data?
Well, Matt, this is the standout. It's core inflation at a record level now in the Eurozone, 5.6%. That was above the Bloomberg economics estimates, above the estimates, the consensus estimates coming through around the surveys. And therein lies the conundrum then for the ECB, the challenge for the ECB. We heard from Madeleine Lagarde, of course, the president of the central bank, speaking earlier, saying that more work will need to be done, that March is likely going to be 50 basis points. But the market's now starting to think about where we go from here. 2.5% is where rates are at across the Eurozone. Do we get to 4%? That is the market pricing. And how much does that adjust as well on the back of this very strong inflation data once again? So 5.6% core if you strip out energy and food prices. And that's been doing some work as well. So the yield story, you're absolutely right to zero on that because there's been a lot of work being done there in terms of the sell-off across sovereign bonds and German bonds as well in focus. And we'll bring that to your attention. 324 then, a move of 4 basis points. In the last 30 days, you've seen about 70 basis points in terms of the move higher in German yields. And of course, you've seen that around the peripheries as well. And that's a concern, of course, for the Eurozone as well. The BTPs, Spanish and German debt. Euro dollar 106, just down 0.4%. Dollar, of course, stronger in the session. A couple of corporate stories to bring to your attention on the earnings front. The world's biggest brewer, AB InBev. Top line, it was a beat in terms of the earnings for the fourth quarter on profits. But then concern about volumes. They dropped, actually, for the first time since the early stages of the pandemic, and softness in your market in the US as well. So potential concerns for AB InBev going forward in terms of the demand outlook. And when it comes to the London Stock Exchange, we had a Bloomberg scoop about the fact that ARM, of course, the semiconductor designer that is owned by SoftBank, is no longer going to be looking. It's ruled out a listing on the London Stock Exchange. So a blow there for the LSE group. They also came out from earnings. They did raise their dividends as well. So a slightly brighter picture on the earnings front, but concerns if you don't get the likes of ARM listing on the London Stock Exchange, currently down 1.4%. Matt. We're also going to get more euro area inflation, of course, in terms of the details, in terms of the context, and who better to join us than our Europe correspondent, Maria Tadeo, to give us that context. Maria.
Look, Tom, this was the number, the data that we were expecting the entire morning. We now have it. You went through the numbers, but let's go through the numbers once again. Headline inflation for February in the euro area came in at 8.5%. It is a slightly tick up down from the previous month when it was 8.6%. But when you look at core inflation, and this is really the print that the European Central Bank pays attention to, you see that jumps to 5.6% compared to 5.3% the previous month. Obviously, the two numbers are way above the target for the European Central Bank. The data today obviously matters in the context of this upcoming decision in 2 weeks' time from the European Central Bank. 50 basis point hike, very much baked in. The data today, to some extent, is also not a surprise. If you look at the prints that we already had from Spain, from France, from Germany, that shows this battle to bring down inflation is far from over.
You were at the Bundesbank yesterday. What did Joachim Nagel tell you?
Well, to some extent, the data that we have today will validate his case, because what he told me is you have to read through the energy effects on inflation and focus on the core, and that is problematic. And he told me at this point, when you look at the data that we have, when you look at the signals that are coming from the economy, those 50 basis points in March are very necessary. Let's have a look.
It seems to be the case that inflation is very stubborn. And that is bringing me to the point that monetary policy has to be more stubborn. It's not fair to speculate what is the sequencing beyond March. But it looks like for the moment that 50 basis points for the March meeting, very necessary.
And that was obviously the head of the Bundesbank, Mr. Nagel, speaking to us yesterday. Now, he says it's not fair to speculate beyond March, but Matt, you know the speculation will be now entirely on May, given the data that we have, or we're going to see now back-to-back 50 basis points, March going into May too. That's essentially where the debate is at.
Yeah, absolutely. There are already bets on more than 4%, pricing in of more than 4% expectations for the terminal rate in Europe. People are betting on 6% here in the U.S. So we really see this inflation data putting upward pressure on those expectations. Maria Tadeo talking to us out of, where is she? Where are you? Are you in Frankfurt?
Brussels.
Brussels,
No,
okay.
Brussels.
Back in Brussels, the European capital.
I have to sleep in my bed at one point, Matt.
That's good. I'm glad you finally got a chance to get home after globetrotting. She was in Poland, then she was in Ukraine, then she was in Frankfurt, and now she's back in Brussels. So good that she's back home. Let's get to what the Fed, Tom, is talking about.
Yeah, of course, the Fed now, officials, we've been hearing from Novo Note saying interest rates will need to increase further, of course, and stay elevated into next year as inflation, of course, shows very little signs of abating. President, of course, Neil Kashkari, Fed president, spoke yesterday. Take a listen.
I'm open-minded at this point about whether it's 25 or 50 basis points. To me, what's much more important than whether it's 25 or 50 is what we signal in what's called the dot plot.
Okay, that was, of course, the Minneapolis Fed president there speaking in terms of the signaling around the dot plot. For more analysis, let's bring in Bloomberg's Valerie Teitel for some context. Valerie, Kashkari then mentioning that if his terminal rate expectation is moving high, did he give any details on whether he thinks that that terminal rate and his view, his dot plot, is going to be moving higher?
Look, he really stopped short of signaling that his dot is definitively moving higher, but he put a lot of emphasis on it. Remember, we get the updated dot plot at their next meeting in March. Kashkari is one of the most hawkish members. He's at 5.4 terminal rate. How much higher is that going to shift in the dot plot that we get in March? That is the big question. But look, he stopped short of saying it definitively. He said instead we should not overreact to 1 month of data, but he did call the recent data concerning. And let me show you something that was concerning in the ISM manufacturing print yesterday, Tom. It was the prices paid subindex. Many see this as a leading indicator for goods inflation. It unexpectedly jumped, possibly hinting that goods disinflation will slow in the next CPI print.
We've seen this bond sell-off. It's been pretty relentless. We're getting back to the highest levels we've seen in 10-year treasuries in some time. I think we're at a November level. What could cause that to turn around?
It has been relentless. In all of February, yields have been on a one-way track higher. After that ISM print, we had the 2-10s curve inverting to a new low. It hit negative 90 basis points yesterday, and 2-year yields crept higher in the Asia session overnight. The big kicker for this, in order to see some sort of give up on this yield move, we're going to need to see some softening data. We have U.S. jobless claims today. We also have ISM services on Friday. Any hint of a softening data could maybe see this yield sell-off pause.
All right, Valerie, we'll watch for that initial jobless claims and continuing claims coming out at 8:30 a.m. We'll pay very close attention, obviously, on surveillance. Thanks to Bloomberg's Valerie Teitel. Now, Elon Musk's much-hyped master plan for Tesla fell flat with investors. The 4-hour presentation yesterday failed to offer any firm detail on the company's next generation of electric cars, and the current generation is looking very long in the tooth indeed. Executives touted Tesla's ability to get production facilities up and running quickly, and Musk expanded on his plans for a lithium refinery in Texas.
We need to make just a very giant amount of anode cathode lithium hydroxide, lithium carbonate. It's really the refining capacity that is the biggest choke point. Yeah, so that's why we're building a lithium refinery in Corpus Christi.
All right, that's the kind of in-the-weeds commentary that investors weren't really psyched about. Elizabeth Behrman, Bloomberg EMEA Auto's team leader, joins us now for more. So what does Tesla's push beyond making batteries further into the upstream tell us? What's the takeaway for other car makers as well?
Yeah, absolutely. I mean, Tesla, as we know, is already very well, highly integrated compared to other car makers. But the comments that we just heard from Elon Musk there very much echo what we're hearing from Volkswagen and from BMW as well, that they're really concerned about sufficient lithium refining capacity in particular. And as we see EVs go into the mainstream for traditional car makers as well, they will be very closely watching what Tesla is doing, and they'll be put on notice by this move, no doubt.
What are the potential pitfalls of this move then?
I mean, going very much up or down on what your core expertise is obviously has the risk of you ending up being spread way too thinly. Then again, Tesla is quite experienced in this, but their core expertise remains in car making. Over the past couple of years, 90% of their revenue and profit, all of that came from selling cars. On the other hand, setting up a refinery, that's not the same thing as setting up a mine, which would be really outside of what Tesla is good at and known for.
All right, Bloomberg's Elizabeth Behrman talking to us about the Tesla report yesterday. I think most of us watching the car maker are waiting for the Cybertruck, waiting for the design language to break away from the decade-old look that was kicked off with the Model S. Let's take a look at some of the stocks that we're watching in the pre-market today. Aside from Tesla, it is down in the pre-market trade, but Microsoft is off as well. We're watching that as the Biden administration is set to release an aggressive new national cybersecurity strategy today. It looks to shift the blame from companies that get hacked to software manufacturers and device makers, putting it on a potential collision course with big technology. Senior U.S. officials have publicly complained that tech companies, including Microsoft, have failed to sufficiently secure user accounts. And we're going to have more on that story later in this hour. Silvergate in the crypto space, plunging in pre-market. It is a crypto-friendly bank. It has said a number of things. One, it can't file its annual report right now. That's a red flag. Two, indicated it's being investigated by the Justice Department. Bloomberg has reported that already. And three, it said its accountant has asked for proof that it can continue as an ongoing concern, meaning will it be able to stay in business or collapse? Those worries are what's driving it down 30% in pre-market trading. Coinbase CEO Brian Armstrong was on with us yesterday, reiterated that the largest U.S. crypto exchange's staking product should not be classified as a security amid a broad regulatory crackdown by the SEC. Gary Gensler disagrees. The stock is already down 83% so far in 2023, and it's falling another 3 1/3% today. And then on the upside, CRM, Salesforce, It gave an upbeat forecast for the coming year, and it plans to step up its stock buybacks. Operating margin is going to be 27% for the fiscal year. That trounced an average analyst estimate of 22.4%, and it increased its share repurchase program to $20 billion. Investors like that a lot, and that's why it's up 15% in the pre-market. Tom?
All right, coming up, Eric Nelson, Wells Fargo macro strategist, will be getting his views, of course, on the inflation question for these central banks and how to position. And we're going to talk the global energy crisis. Of course, that ties into inflation very clearly with the CEO of SoCalGas, a California utility company. What more can they do around pricing for consumers and businesses? Plus, how a 90s rapper got sucked into the 1MDB scandal. This is a fascinating story. Read more on today's Big Take story online or on the Bloomberg terminal. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
From our studios in New York and San Francisco, our new hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Welcome back to Bloomberg Surveillance, the early edition. We are simulcast on both radio and television. If you are listening on radio, I've got a chart. This is one of those rare instances where lacking the visuals is going to help you better understand the point. Basically, European investment-grade bond issuance is at the highest level this year than it has been in the last 5 years at this point. And actually, it has been from many points this year. There are a number of different lines making this a bit of a spider chart. That's a new term that I've just been introduced to by Priscilla Azevedo Roca. She is a Bloomberg credit reporter. She joins us live out of London to talk about, the point essentially, Priscilla, is that we're still at a high in terms of issuance at the end of February, beginning of March. Why is that as we see these rates rising ever higher?
Hi, Matt. Good morning. So it's exactly that, right? So we had historical high issuance this year. So companies are selling bonds like never before. And this is only a sign of anxiety. It's anxiety by companies and treasurers. The rates are going to be higher for longer. So they need to get in and they need to sell their bonds before it's too late. And today's inflation print is just one more proof to that, right? It's going to become more expensive to the point that it can get even prohibitively expensive to do so.
So the data today kind of justifies that anxiety. Where is that anxiety most acute? Which sectors, which companies are at the forefront of issuance?
At the forefront of issuance right now is investment-grade companies, right? Because they still have the ratings, they still have market access, and investors are still buying into them. We've seen earlier this week bonds from like McDonald's, from BASF in Germany. So those are national champion names that people like to buy and they know them well. But on the other side of this equation, we have junk companies, right? Access for those have become more complex over this year as rates shoot higher.
On the IG part of that equation then, is there demand holding up? Thank you. Really important story to bring to our viewers' attention. Bloomberg's Priscilla Azevedo-Roca, thank you. And for more market analysis, of course, from Priscilla and the rest of the team, check out MLive Go on your terminal. This is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Tom McKenzie in London. Anna Edwards is off today. Now, keeping you up to date with the news from around the world, here's the first word. The European Union is set to propose a plan to provide Ukraine with much-needed ammunition. It calls for the immediate transfer of ammo, especially artillery rounds, from existing stocks. The proposal is also envisioning a ramp-up of Europe's capacity to meet current and future needs. In China, a sign that President Xi Jinping's campaign to tighten the Communist Party's grip on the financial system has a long way to go. Chinese bankers are being told to change their mindsets, clean up what's called their hedonistic lifestyles, and quit copying Western ways. The warning came in a commentary from China's top anti-corruption watchdog. The Chicago Fed hired a search firm to help find its new president, Austin Goolsbee. One of the diversified search group's executives is none other than Goolsbee's wife, Robin. The Fed says it was aware of Robin Goolsbee's position at the firm and that she had no involvement in the search. SpaceX launched a 4-person crew to the International Space Station early today. The crew includes 2 Americans, a Russian, and an astronaut from the United Arab Emirates. They'll arrive at the space station on Friday, and they stay there, Tom, for what I'm being told is the standard 6 months, which seems like, to me, a long time to sit in the International Space Station. 6 months.
That is quite the stint, isn't it? You'd hope that the relationships between those individuals is going to be strong to sustain them through that period. So yeah, Kate taking off the Kennedy Space Center. I don't know if you managed to watch it, Matt, but always impressive to see this.
Yeah, it's amazing. I did watch a replay of it, and we just showed some video. It's always impressive to me that SpaceX, that a private company, is launching actual people up in space, and hopefully someday soon to the moon.
Yeah, 9th manned mission, 7th to the International Space Station. Coming up, Eric Nielsen, Wells Fargo macro strategist. Stay with us. This is Bloomberg.
Specifically?
1953 has a lot of relevance in general. So that's the year where the European countries start opening up their imports to the dollar zone. It's the London debt deal with the Germans after the war around German debt. But it's also one of the years where the Fed is really forced to make a really important decision. So it's where a lot of their desire to get out of the bond market, and I'm sure we'll talk about what they did during the Second World War. It's a very controlled market. It's very heavily managed by the Fed on an active basis. They really pegged yields in the long end, and getting out of that is complicated. And in 53 is when the market really tests them. So we didn't have the "don't fight the Fed" mantra quite yet at that point.
But this is like a really interesting philosophical question right here, because there's always this question today or in any period, to what degree is the rate that we see on a 10-year, on a 30-year, on a 2-year, a policy rate versus a market rate? Before we get to 53 specifically, can you just talk a little bit more about what you said about how rates across the curve were essentially policy rates?
Yeah, when we think about a 10-year rate, like you could do one of two things. You can roll treasury bills every 3 months for 10 years, or you can buy a 10-year bond. So in a perfect world, those two things are connected through expectations.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg.
This is Bloomberg's Values Early Edition, and here's what you need to know. Euro area inflation slowed by less than anticipated, while underlying price pressures surged to a new record. The data likely to be the crucial factor in determining what the ECB does next on interest rates. Elon Musk's master plan for Tesla falls flat with investors. He fails to offer any firm details on the company's next generation of electric vehicles. And this could feed the worst fears of crypto watchdogs. Silvergate Capital warns that it needs time to figure out just how badly it was hurt by last year's crypto rout. I'm Tom McKenzie in London. Matt Miller, of course, in New York. Anna Edwards is off today. And Matt, beyond the corporate stories around Tesla, the focus, of course, on that hotter than expected, at least core inflation out of the Eurozone.
Yeah, absolutely. I mean, that inflation number, a record high in the core, is putting upward pressure on rates in Europe, and it's really traveling around the world. So let's see what's going on here in U.S. markets first. S&P futures down about 0.5% right now. This after the drop in the cash trade yesterday. So we're down. I think the cash close was somewhere around 39.50, down well under 4,000, and we could fall further this morning. The U.S. 10-year yield climbs to the highest level we've seen this year, up over 4% yesterday. It's up another 4 basis points right now at 4.03, and this is really the highest level we've seen since November. We're getting back to that 2022 record of 424, I think 425 was the record high. We touched on 10-year yields. We may revisit that. The Bloomberg U.S. Dollar Index climbing today. It was down yesterday, but up again to 1251. Now we're again 100 points away from the high that we saw last year. But this really puts pressure on risk assets as well. The stronger dollar puts pressure on stocks, for one thing, around the world, and that's not going to be a good thing for the open this morning. And then NYMEX crude finally going a little bit higher. I've been waiting after the good data that we had out of China overnight yesterday and the reopening talk that we've had over the past few weeks and months to really drive commodities and crude. It hasn't yet, but maybe it's starting. We're looking at WTI at $78.20 a barrel. In terms of pre-market movers, Silvergate is one that Tom mentioned. It's always a concern when a bank, especially a crypto-friendly bank, says it's not really aware of the damage done by what happened last year. They should know minute by minute how they're doing financially, right? They don't, though, so they couldn't file their annual report yet. They also indicated they're being investigated by the Justice Department, which Bloomberg has already reported, and they said their accountant has asked for further data so they can confirm that the company can still survive. Worries of a collapse driving the stock down 30%. Coinbase falling maybe a little bit in sympathy there. Also, Brian Armstrong, the CEO, was on with Sonali Basak here yesterday and pushing back against the SEC and Gary Gensler's assertion that staking, what it does for Ethereum and other proof of stake blockchains, is not a security. Certainly the way they operate it, the SEC thinks it is. Plug Power is down after reporting net revenue for the fourth quarter that missed the average analyst estimate. So you can see some EV companies are getting hit like Tesla, but also Plug. Net revenue was up 36% at Plug compared to the same quarter a year ago to $221 million. But the problem is analyst estimates were for $264 million, so a big miss there. And a beat from Salesforce, at least in terms of the forecast for the coming year. It was very upbeat, and stock buybacks don't hurt. Operating margins at Salesforce are going to be 27% in this fiscal year. That trounces the average analyst estimate of 22.4%. And Salesforce says it's going to buy back $20 billion worth of shares. Investors like it. It's up more than 15% in the pre-market. Tom, what do you see in Europe?
Yeah, Matt, at least the earnings story slightly overshadowed, at least here in Europe for now, as we look at this inflation data. Central banks back in terms of the front of the agenda for many of these investors. And yes, we had that core inflation, a record for, of course, the European or the Eurozone. So the adjustment there, 50 basis points, as Maria was saying, is essentially baked in for March, for the month of March from the ECB. The question is, does that happen again? Do you get another 50 basis points, of course, in May? So European equities are lower, and that is a factor, certainly. There hasn't been a huge move in terms of sovereign debt, because of course we have seen a run up in yields, and of course the context, and I'll just bring in focus the 2-year, the front end of the German debt market, 321 there. The context over the last 30 days or so, you've seen a run up about 75 basis points. Not a lot of change here, not hugely surprising, of course, on the inflation front, given the surprises upside that we saw from the likes of Germany, France, and Italy. But nonetheless, we are continuing to watch what is happening in terms of sell-off in the bond space. Euro dollar 106 hasn't been a lot of change in terms of the single currency over the last few days, just softer by 0.4%. A large part of that is going to be dollar strength, of course. And there's individual corporate stories to bring to your attention. The world's biggest brewer, AB InBev, fourth quarter profits actually came in a slight beat, but the volumes dropped for the first time since the early stages of the pandemic. There's certainly concern about the demand in the key US market as well, whether or not they can continue to push through prices. Bloomberg Intelligence says it's going to be a challenging year for AB InBev. Of course, the inflation picture consequential for them. The London Stock Exchange, a Bloomberg scoop that ARM will not be listing on the London Stock Exchange. So a blow there for the political class of the UK, but also, of course, for the London Stock Exchange Group, currently down 1.8%. ARM, of course, owned by SoftBank. They're going to look to the US. Matt.
All right, Tom, thanks very much for that. Let's talk now about the macro picture again with Eric Nelson. He's a Wells Fargo macro strategist and joins us after, Eric, we got record high core inflation for the Eurozone, continuing to get prints that are higher than economists in our survey at least have estimated. Is it a concern to you, and do you think that the ECB is going to have to go well above 4%?
I'm not sure that the ECB is going to be able to necessarily get much above 4%. I think 50 basis points is pretty much set for the next meeting. Could well see another 50 basis points. The question for me, and looking at the currency reaction today, I think that's so interesting, because for the last 15 years or so, strong inflation has tended to be very positive for a currency because it means a more hawkish central bank, higher nominal rates. What we're seeing today, though, is euro is not outperforming. And I think this could be the start of a regime shift where if you have de-anchored inflation and the central bank can't do a lot about it, that may not be so currency positive anymore. And I want to really watch this theme and this space going forward.
Okay, so the movement around euro-dollar, the lack of movement, could signal potentially a de-anchoring there. In the yield space, is there a concern? Have they addressed the concern about the peripheries as they move up to potentially 4%, as some of the markets expect? Does the periphery become more of a concern, or do they have the tools to address that?
Well, I think what's been so remarkable, Tom, in this market reaction to the higher terminal rate and also the higher yields is you've actually seen a greater reaction in German yields as opposed to some of the periphery, which I think has got to be very comforting for the ECB. And I think allows them to continue to be relatively hawkish as long as that periphery risk remains relatively contained for right now.
What is the adjustment that is needed from these equity markets to the higher rate scenario that's coming through from the ECB? Have equity markets properly adjusted to this new reality?
Well, what's been so interesting about the European market reaction is actually a lot of the move has come in terms of nominal yields and not so much real yields. So a lot of it is inflation compensations rising. And so that's not necessarily super negative for European equities. So until we see the real yield picture start to change, European equities can maybe hang in there.
We've seen the real yield picture change here. At least that's what Jerome Powell points to when he says financial conditions has tightened. Of course, the rest of the Wall Street is like, what? Financial conditions are really very loose by our measures. What do you think of the Fed's path to beating inflation, and are they going to have similar problems?
Well, what's really key to me about the Fed at this juncture is that they're committed to sticking with 25 basis point hikes. And that's a huge shift from last year when they were going in 50 and 75 basis point increments. So if you see a little bit of a reacceleration in activity here, even if you're still of the view that a recession's coming in the second half of the year, which we are, if the Fed is not going to lean against that acceleration in activity, that can, I think, help risk stay supported for the next little while here. Very different story in the second half if we see the growth environment start to turn negative. But for right now, we can be a little more constructive in the risk environment.
The labor market seems to be really the linchpin here, Eric. Am I reading that right? I mean, if we start to get a real move up in unemployment, that's when the Fed starts to consider a pause or a pivot.
I think that's absolutely right, Matt. And that's really where the recession tends to start. The reason we haven't seen a change in spending patterns, we haven't seen a real fall off in that very strong consumer sector in the U.S. is because the labor market's been rock solid. And until that changes, the Fed's going to continue to move in 25 basis point increments. You probably see more cuts priced out, again, until we start to see that real weakening in whether it's jobless claims, payrolls, those really key labor market indicators that tend to be warning signs that a recession's either already here or looming very, very soon.
Eric, 489 at the front end on the 2-year in the US. How much more work needs to be done at the front end, do you think?
Well, I think the terminal rate, Tom, is pretty well priced. To me, is how much more of these cuts in the U.S. are priced out in the end of this year and really the beginning of next year. That's where I think more upside can come in the front end. But as you get closer to 5, especially with where the terminal rate's priced, you start to think about that's probably close to a top.
Do you think we get to 5%?
I think we do.
We get there. Yeah. Okay. Eric Nelson, fantastic analysis. Thank you very much indeed of Wells Fargo on the inflation data out of the Eurozone. Of course, the prospects around further hikes from the Federal Reserve. The big risk is if they have to go back up to 50 basis points. Now, Chevron's CEO is optimistic about China's reopening. Part of our interview is next. Stay tuned. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Tom McKenzie in London. Anna Edwards is off today. Now, Chevron CEO Mike Wirth says rising Chinese oil demand and dwindling spare production capacity around the world may push crude prices higher later this year. He spoke with Bloomberg's Alex Steele yesterday.
We raised our dividend. We're investing to grow. Last year was our largest U.S. production ever. The Permian's going to grow another 10% this year. The balance sheet's very strong, and the cash that we have surplus to that, we've always distributed back to shareholders through a buyback. The company's stronger today than it was just a few years ago, so the numbers are larger, but the approach is very consistent.
So the White House has not called you yet?
I haven't gotten a call.
Okay, I'm just asking. You never know. The other part of that, though, is that a lot of investors would much rather have you buy something than deliver a juicy buyback like this. What do you say to that? Consistently, you're saying no.
Well, just because you can buy something doesn't mean you should buy something. You should buy the right thing at the right time. And I think we've got a track record of well-timed M&A. We were the first one during the downturn in COVID to do a deal with Noble Energy, which has been a very, very good deal. Nice deal with Renewable Energy Group last year. So we've not been reluctant to do acquisitions, but they have to make sense. They have to create value for shareholders. They have to fit with our portfolio. And so we'll continue to be patient.
So I think where it becomes the broader issue then is that everyone's looking for a catalyst. Like everyone likes your story. All the analysts like your story, but they're all neutral. Well, not all of them, but a lot of them are neutral on the stock. There's no juicy catalyst. There's no extra bump. The stock has not performed in line with Exxon, say, or even BP after its recent announcement a couple of weeks ago.
Well, the whole industry is re-rating. This is an industry that for a decade languished relative to the rest of the market. And frankly, over the last couple of years, I think our story's gotten traction with shareholders, and we've performed very well. I see other companies now that are experiencing some of the same kinds of things. The sector as a whole is still undervalued, Alex. Last year, we generated 12% of the cash flow in the S&P 500, yet only represent 5% of the market capitalizations. The multiples and the valuation that's attributed to the strong cash flows in our industry are not yet showing up in stock price. So we're seeing a lot of companies now coming back. Everybody's kind of had their own journey to get where they are, and I think the sector still has a lot of room to improve.
How does Chevron not be boring?
Well, we're predictable. We're doing what we said we would do. Sometimes that's called boring. Sometimes that's called safe, reliable, steady, and predictable. I think we've been consistent. We've been disciplined. We've said what we're going to do. We said we're going to deliver high returns and lower carbon. We have seen returns improve significantly. We laid out a plan to grow free cash flow 10% per year for the next 5 years. Carbon intensity down 30%, and we're distributing cash to shareholders. So we're doing it all.
Do you feel pressure to close the gap with Exxon stock, for example, when you've really outperformed them for so long?
Well, it's a long cycle game. Exxon's had their own journey. We've had our own journey. They're a great company. They're performing very well. They're a worthy rival. I enjoy the partnership we have with them in some places and the competition we have with them elsewhere. And I'm pleased to see them and others in the industry doing well.
What is an environment where you would consider another acquisition? Is it depend on the oil price? Is it dependent on the Permian and peak Permian? Like what does Mike look at to know whether or not it's time to pull a trigger?
Well, we're constantly looking at companies, and really, you know, the first thing you look at is asset quality. Are these assets we would invest in? Would they make our portfolio stronger? We look at strategic fit. Do they fill any gaps that we might believe that we have? We look at valuation. We look at financials. Are the financials accretive to our base case? And we've got a very strong base case. So you've got to have a deal that really creates value in order to do better than what the steady as she goes case is. And then, of course, you want a company that wants to transact. We don't do hostile transactions. And so you've got to have a counterparty that's ready. So there's a whole confluence of events that have to come together. We're always looking. Sometimes we're actually talking. But you know, when we have something, we'll come and I'll talk to you about it.
Chevron CEO Mike Wirth speaking with Bloomberg's Alex Steele yesterday and saying that he expects crude prices to face upward pressure due to the reopening. This is something we have been expecting, Tom, for a long time, right? It's just not clear, it seems, from the market reaction whether investors believe that crude is going to go much higher. Otherwise, why wouldn't they buy it now?
Well, this was a conversation we were having with Jeff Curry of Goldman Sachs yesterday in the London studio, and he's saying, look, the demand coming through from China will offset any slowdown that we're seeing in the US. But he says pivotal for investors will be that moment when the Fed either pauses or cuts. He says that is when the money will flow in.
Yeah, well, I think everyone is and has been waiting for that moment for like a year now. If you could call that moment, I believe you would have it made, or at least you wouldn't have lost as much money as you did last year. Coming up, we're going to speak with the CEO of energy pipeline company Enbridge, Greg Ebel. That's at 10:30 a.m. New York time, 3:30 p.m. in London. This is Bloomberg.
let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
This is Bloomberg's Surveillance Early Edition. I'm Tom McKenzie in London with Matt Miller in New York. Anna Edwards is off today. Now a look at what is ahead today. Retail earnings continue with Macy's and Best Buy reporting for the US Open, of course, consequential for the strength of the US consumer. ECB minutes, they're out at 7:30 a.m. Eastern time as we debate whether or not a 50 basis point hike comes through from May, let alone March. US initial jobless claims out at 8:30 a.m. and at 9:45 a.m. Washington Bureau Chief Peggy Collins will be speaking with US Secretary of State Gina Raimondo. Matt.
All right. We have, speaking of the U.S. administration, the Biden administration, it is on a potential collision course with big tech companies. Of course, it has been on a collision course with big tech companies, and so was the last administration. But today, the Biden administration is coming out with an aggressive new cybersecurity strategy. The plan seeks to shift the blame from companies that get hacked, if you were blaming them, to software manufacturers and device makers. Joining us now to discuss is Bloomberg tech reporter Agatha Cantrill. Aggie, what could this strategy mean for big tech, especially for Microsoft?
Yes, so essentially a crucial part of this is shifting that onus from the users and from the companies that use these platforms and use this software to the companies that develop it. This is something that the Biden administration has been sounding the alarm about in the past, especially when it comes to Microsoft, questioning the extent to which Microsoft has actually been protecting its users, its end users, when it comes to its cybersecurity measures. And so a big part of this is essentially what that means for legislation that can be developed to make sure that the responsibility lies with those big tech platforms. And what we're seeing is essentially this is yet another attempt on the part of the Biden administration to rein in these tech platforms. But there is a hope that they could potentially be able to develop legislation that they would be able to push through Congress. But as of yet, that hasn't been successful for other legislation of this kind.
No, it hasn't. And of course, hacks have been a long-term headache for big tech and the businesses that use that technology. Why is the stricter approach coming now, Aggie?
There's a part of it, Tom, which is essentially about this being, there being a lot of bipartisan appetite for strengthening cybersecurity. And something I noticed recently when I was looking at the tech companies that were at the Munich Security Conference a couple of weeks ago, cybersecurity has also become an inherent part of national security for a lot of countries. And cybersecurity, when it comes to Microsoft, when it comes to Google, all of these companies were present at the Munich Security Conference and indicating the huge role that cybersecurity plays. And we see this also being rolled out in Ukraine, where the cybersecurity and securing the cyber infrastructure of Ukraine has been a critical part of their war effort against the Russians. And so this is also not just saying that this is a company concern, but also it's a national security concern as more and more critical data goes online.
Okay, Aggie, thanks very much for that reporting. Bloomberg's Agatha Cantrill reporting on the big push against big tech, mentioning the Munich Security Conference, which, by the way, was my first big gig with Agatha when she started for Bloomberg. A great conference to go to, and a lot going on down there. We interviewed Miles Davis, actually, at that conference. Not the musician, obviously, Tom.
I was about to say I had the musician. That would have been that would have been particularly cool, man.
Back from the grave.
Yeah. So from one conference to another, I was at the Mobile World Congress this week. It's the biggest mobile and telecoms event. They were talking about cybersecurity, and a big push is around satellite communication networks. So the Europeans wanting to emulate what Musk has done with Starlink, precisely because they think it will be more secure.
Yeah, I imagine that every region, especially those that aren't allied, need to develop their own competencies in all of these tech areas. You know, that's why a lot of people are so worried when we report on crypto that the U.S. is so far behind China. They've already got their own CBDC rolled out, and we're still struggling with regulation.
And it's part of the rationale. It's part of Chinese policymakers' rationale for reining in the tech sector is concerns about data security. You can think of DD as an example. When I was in China, I remember hearing officials saying, we're concerned that data is going to be accessible to the security services in the US. So it all ties in, doesn't it, Matt?
It's an ongoing conversation. We're going to continue to be talking about this for sure. That's it for Early Edition, but the OG surveillance is ahead with Lisa, John, and Tom. We'll hear from Dan Ives of Wedbush, among others, after Tesla. This is Bloomberg.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. coverage begins next week on Bloomberg.
Central banks had hoped that by now there'd be clearer evidence of services inflation easing off, but that just doesn't seem to be happening.
I'm not sure necessarily we're going to be getting back to expansionary environment just yet.
The trade into what we'd call more cyclical parts of the market probably happened too fast, too soon, earlier on this year.
We're still going to see prices going up here. That's the main event.
I'm still medium term of the opinion that this monetary tightening will see the economy suffer in the future.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Hello, 4%. Live from New York City this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures right now down 0.5% on the S&P 500. 1 hour ago, Eurozone CPI, TK, record high.
Once again, what we've seen here, the trend of the last number of days and frankly the last number of weeks, John, this screen that I'm looking at now in the Bloomberg I've never seen. What period is that? It's not 1994. It's not 06, 07. There is something moving here. And the word the pros use is convexity, which is French for car acceleration. Like if you're in Bahrain and you're Alpha whatever, and you got to catch up with Aston Martin.
Well done.
Very nice, Lisa. You accelerate.
Thanks.
Right now, we're accelerating. We're seeing it in 7% above mortgage rates and that 4% 10-year yield.
So to confront core CPI in the Eurozone at all-time highs, what does the ECB do? They're going 50 basis points this month.
No choice.
Do they have to tee up another 50 basis points? Lagarde was speaking to Spanish TV a little bit earlier this morning, Tom. It feels like that's the direction it's going in.
This is not about the central banks now. This is about observable data that's not slowing down. It's not transitory. There's going to be a new urgency to this and all the different comments that Lisa talks about, John. And all I can do is go to the screen, and the screen is new. The comparison of the 2-month and the 30-year is extraordinary. Never seen it.
Well, let's go through the curve, piece by piece. The 2-year in the last 24 hours, through 490. Then we break 4% on a 10-year, I think for the first time since November, is that right?
Correct.
So a 10-year this morning still hanging in there, in and around 4%. Lisa, up another 2 or 3 basis points.
So here's a question. How far do central banks have to go to just get to neutral? And I think that's the new question, because right now the fact that inflation is still accelerating has people concerned that maybe we haven't gone as far as we think we need to go just to even stabilize the economy. And that, I think, is the fear. What I also think is interesting on the heels of that data out of Europe, why is the euro losing versus the dollar? Really, because does this basically indicate that they think that the ECB is going to raise rates enough to diminish some of the economic trajectory there?
You can't look at just the pair in a vacuum. You have to triangulate. And about 40 minutes ago, you were just getting in. About 40 minutes ago, I triangulated euro-yen. And the answer is,
what did you find?
Euro with convexity. Euro with convexity is strong euro. Japan's being left behind, I get it. But that's a key technical break. If you have euro-yen break out to new euro strength, that really shows how they're both ratcheting up along with all these rates.
There's a global story here right now between Europe and the United States, and Japan's a feature in all of this as well. Inflation's looking stickier. What was interesting about the ISM yesterday, ISM manufacturing, the headline number wasn't tremendous. It wasn't terrific. It was an improvement. It was still sub 50. The prices paid component just spooked people. And Lisa, that speaks to the moment. Adam Ruskin of Deutsche Bank wrote about this yesterday. Anything that speaks to sticky inflation, that data point did. This market does not like it one bit.
Which really highlights that this is the new narrative, right? Sticky inflation, stickier than we thought. Anything that confirms that is only going to spook markets, and then they'll just ignore the other data. So are we going to go too far on that, as we went too far, perhaps, on immaculate disinflation?
Equity futures right now down 0.4% on the S&P. Let's whip through it for you. Starting with the equity market, just a little bit softer, lighter, lower, negative on the S&P. In the bond market, yields a little bit higher by a couple of basis points. Get used to this, maybe. Your 10-year, 4.0162% on a US 10-year. And just to finish on foreign exchange, euro dollar confronting a record high core CPI reading out of Europe this morning. Lisa, just a little bit weaker on the euro side of things, 106.19.
Which I find fascinating, because we just saw a hotter than expected CPI print, and you would think that that would indicate further rate hikes that would be strength, not weakness. We'll get into that later. Today, we do get retail earnings that do include Macy's right before 7 a.m. Eastern, Best Buy, Kroger, all before the market. And then after the bell, Nordstrom and Costco. Do we see what we saw yesterday from Kohl's, which is a negative outlook going forward, negative margin compression, basically seeing a real lack of profitability at a time of inflation? If you take a look at the retailing index, we've gone full circle this year. We basically saw a big recovery as people said, all right, buy all the beaten up stocks. And that's almost been completely given up as we get those earnings. 8:30 a.m., we get initial jobless claims. Could this be market moving in a way that it hasn't been in the past? If it is sub 200,000, as many people expect, does this only confirm what we were talking about before? Stickier inflation, stronger labor market for longer, more that central banks have to do. And today, the Fed speak does include Fed Governor Chris Waller at 2 p.m., Minneapolis Fed President Neil Kashkari at 6 p.m. Neil Kashkari yesterday, John, talking about how he is open to a 50 basis point move at the meeting later this month. This is new, re-accelerating rate hikes rather than staying at that 25 basis point mark.
Not just his comments yesterday, also Raphael Bostic of the Atlanta Fed, the president there, Lisa, talking up maybe 525 well into 2024, just pushing that story right the way through next year.
This is a new trajectory. The data clearly has concerned the Fed members. That is new. This feeling that perhaps they underestimated the stickiness and the strength of this inflation, and I am curious whether that permeates the comments that we hear today.
Let's get out ahead of Friday when many publish it into the weekend. I believe Nomura yesterday began to voice 50 basis point lift. How many others will join them? And my answer is based on what we've seen a lot. 4-week moving average of the weekly claims, a number I have never imagined ever. 191,250.
Incredible, exceptionally low.
That's just, folks, John, I can't say it enough. I've never seen a screen like this.
It's amazing. Next week, Chairman Powell, semi-annual testimony to Congress, so look out for that.
They've never seen a screen like
Let's
this
see if we
either.
get a shift from Chairman Powell in any way, shape or form. Apparently, you can look through the whole of the summer and just get to September. Kit Jukes of SocGen's going to join us now. He says, wake me up when September ends. Kit, what happens in September?
Rates peak according to the forward curve, and the only question is how high they have to get. Look, I think that this is the piece. I mean, there's been no progress in, inflation economics since 2000, for the sake of argument, until recently, because we didn't have any to analyze. So we're making it up as we go along. We're in unprecedented times in terms of the volatility of the economic data, which means we are doing our best to interpret numbers that are permanently surprising us on all the bits of the economy. The one thing we know is they've got to go harder. And the one thing that most of us, I think, feel is that in the end, they're going to have to go hard enough that something's going to break. And wake me up when we know where that is.
Kit, we're having a financial discussion, maybe on a Hicksian basis. We're on the LM curve. But the reality is we live on the IS curve. What happens to our assets, to our property, to the things we own with the convexity we're seeing in interest rates?
Well, this is kind of, put simply, it's back to these large and variable lags that we all talk about so lightly. Is how do you slow something down that you don't understand, except by eventually leaning on the brakes hard enough that something breaks? And what breaks are asset prices, nearly always, and then the real economy. So this is dangerous. Not dangerous because the Fed's doing a good or a bad job, or the ECB's doing a good or a bad job, but because they don't understand, we don't understand. It's all very new. The data are all over the place relative to expectations. So they have no choice but to talk about going 50, but to risk doing too much. Tell us that that's some idea of neutral. They have no idea where that is, and go too far.
I was talking about triangulating foreign exchange pairs to get out to September, to see you in September. Which pair is most efficacious? Which pair can I profit from?
I think right now you can start off profiting out of euro-yen, to be honest, with respect to where you were, because the Japanese are talking down rates even as they're facing up to the need to come back with further yield curve control. So we saw at the end of last year clearly short-term rates moving in line and expectations of where BOJ policy rates would go in line with the rise in yields. The first thing that Mr. Wade has done is reverse that pretty convincingly. That means that at the moment, both the US and Europe are seeing rate expectations move in the opposite direction from what they've been doing in Japan. and the yen is pretty vulnerable. We could break through some levels that look pretty scary on charts in yen crosses from today at the rate that we're going.
Kit, I think a lot of people would want to go to sleep and then wake up in September, especially the way this market's been going. I'm just curious what you do in the meantime, right? I mean, yes, okay, perhaps the euro-yen is a cross that you'd be interested in, but do you have a safe place to hold on and wait until there's sort of a more clarity in the market?
I'm tempted to say that in currency terms, this might be the time for the Swiss franc to start doing well. I have a sense that the Swiss don't want a cheaper currency at this point in time. They're going to be leaning against that if it happens, just because they don't like inflation and possibly they dislike inflation more than the rest of us, if it's possible for anybody to do that. So I think they'll benefit. I wouldn't be surprised if the market comes back and revisits some of the places like Australia, New Zealand, but perhaps particularly Australia, who've been perceived to be less keen to fight inflation than some others, despite the fact their economy is not in bad condition. Their terms of trade are epic. If they're forced to look at the world and think, yeah, we need to get on our bike and start hiking rates, then they've got some catching up to do. I don't want to hide in emerging markets personally right now if this starts to get dangerous, because rate rises hurt them quite a lot. It's probably too late to just hide in the dollar, in the sense that we've had such a big run. The dollar is very strong up here, having reversed some of this. But the Swiss franc's not the worst place to go and hide in when things get scary.
Hey, Kit, we've got to squeeze this in. You were at the Emirates last night. The Arsenal game looked absolutely fantastic. Watching it on the TV, that goal from Saka just looked absolutely awesome, clinical, top quality stuff. What did it feel like in a stadium, Kit, last night as an Arsenal fan who's been waiting for this moment for a long, long time?
The mood was very good. It wasn't raining. We weren't being beaten. We are top of the league. I had nothing but fun. He did score at the other end from me, so he was quite a long way away when he did it. That's my only objection. Come and score that down my end of the pitch sometime.
Kid, does it look like Arsenal could have beat Sheffield United last night?
I haven't watched that game yet.
Either have I.
It's like double good news for Arsenal
James
fans.
Athey called me up from and he said, don't watch it, Tom.
Spurs lost, Arsenal won. That's a good thing. Top of the league, and it looks real. It's starting to look real in a way that it didn't. I mean, the start of the season when they started to build, there was a feeling that they wouldn't get this done.
Kit, next time in London, Lanesborough, every single guy in the cigar bar is an Arsenal fan.
Kit Jukes of Sochen. Kit, wonderful to catch up. Thank you, sir.
He sounded like a Mets fan. It wasn't a hurricane. We weren't blown away. They didn't lose.
No,
the levels of
It's been a long, long time since they were up here.
I know.
And they may well cross the finish line. Luke Cower of UBS is going to join us in the next hour. Tons to talk about. In the next segment, an ESG showdown between the Senate and the White House. AMH down in D.C. up next.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Inflation in the euro area fell less than anticipated last month, and underlying price pressures rose to a record. That reinforces expectations that the European Central Bank will have to raise interest rates again. Consumer prices hit 8.5%. Core inflation, which is what policymakers are focusing on, rose 0.3 of a point to 5.6%. The Biden administration is on a potential collision course with big tech companies. It's coming out today with an aggressive new cybersecurity strategy. The plan seeks to shift the blame from companies that get hacked to software manufacturers and device makers. The process will require Congress to pass legislation. In the UK, conservative lawmakers say former Prime Minister Boris Johnson's prospects of returning to power have been killed off. The reason? Rishi Sunak's success in securing a new settlement for Northern Ireland with the European Union. Johnson had refused to back Sunak's efforts. China has sent the most fighter jets near Taiwan in almost 2 months. The move came after the U.S. approved the sale of $619 million of weapons to Taiwan. Almost 24 Chinese fighters were detected in the southwestern part of the island's air defense identification zone. And Elon Musk's much hyped master plan for Tesla fell flat with investors. The 4-hour presentation failed to offer any firm detail on the company's next generation of electric cars. Musk said that what he called a proper product event will be held later. Shares are lower in pre-market trading. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. From our studios in New York and San Francisco, our new hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
I called on the prescription drug companies to bring down the price of insulin to $35 to everyone, not just seniors. Today, Eli Lilly, the largest manufacturer of insulin in the United States of America, agreed to do just that. $35. Well, guess what that means? Every other company making insulin is going to have to lower their prices to $35 because they can't compete.
That's a win for the President of the United States. That's the good news. Let's get to the policy effort down in Washington this morning. Here's the latest, an ESG showdown between the White House and the Senate. The U.S. Senate passed a measure to block the U.S. Labor Department from enforcing its new ESG retirement investing rule. If you're not familiar with this is what the rule does. It permits private sector workplace retirement plans to consider ESG factors when selecting and monitoring investments on behalf of participants and beneficiaries. Now, Tom, when we talk about ESG, I think we're using the term a little bit loosely when we think about this showdown. This comes down to one thing: investing in big oil in America. And that face-off, that showdown, is really ramping up. And I thought it was interesting, Lisa, yesterday to see Ron DeSantis, the Floridian governor, in the Wall Street Journal with an op-ed piece on, guess what? ESG.
Yeah, basically saying, quote, a woke CEO can use the corporate bully pulpit to exert influence over society. Basically trying to reduce the corporate rule over how people are supposed to live their lives. That's the pushback.
This is the showdown, Tom, right now.
I think showdown's the right word. In a lengthy campaign, both sides have to find topics to topic about. And I think you're right, John. This is the showdown topic around climate control, all of it adjusted by the war in Ukraine and such. And here we are this early on it. I'm going to go back to a wonderful summary by Betsy Adkins in Forbes magazine a number of years ago. And with Anne-Marie Horton joining us, our chief ESG correspondent in Washington. Anne-Marie, Betsy goes back to May of 2017, where basically the shareholders of ExxonMobil put the management of ExxonMobil in the ESG timeout chair. And they said, no, you are going to look at this. Who holds the cards right now? Who holds the corporate power on the ESG debate?
Well, I think what you're seeing is this debate that has been taking place on Wall Street now really coming to the forefront in the political stage, especially ahead of 2024. I mean, Jonathan was just mentioning Governor DeSantis in an op-ed. He mentions this a lot, this quote-unquote woke capital, and how he wants to cripple this ESG investing in his book. And he's on a national tour promoting this. So this is becoming a hot-button issue because for the Republicans, what they're trying to shed light on is like how how corporations are using what they deem social issues when they come to investing. But the bottom line is you already see places like BlackRock, like State Street, already taking ESG into consideration when they are talking about investing. Also, this labor rule is not a mandate, and you really get that point across when you look at Senator Schumer's op-ed in the Wall Street Journal as well, and just saying that this is something that they should be allowed to look at. But while, yes, this has implications for the financial community, this is really going to be either virtue signaling or a way to get out a completely different message on the political end.
I mean, I got 8 ways to go here. And just because of time and early morning, I'm going to cut to the chase. There's a political polarity. Do you have any sense, or does Gallup have any sense, or any polling or academics, do they have any sense where the middle of America is on this topic?
Well, I haven't seen any polling specifically on ESG investing, but to my earlier point, I think what politicians are trying to do is use this just to talk about other issues, like Governor DeSantis is using this to then talk about a number of other issues in terms of what he thinks Democrats are using in terms of quote unquote woke politics. I don't know if everyday Americans even know this rule in the Labor Department exists.
This goes beyond virtue signaling in Washington. I think you have to get to the state level to think about how this really hurts businesses. And the banks at the moment, the asset managers, may well be stuck right back, slam bang in the middle of all of this. There is a list in Texas, state law that limits government entities from doing business with firms that restrict business and oil and gas producers. On that list already are the likes of UBS and BlackRock. And the Texas comptroller in the last day or so plans to add at least one more firm to the state's tally of financial companies on that boycott list. Now, Anne-Marie, I'm just wondering how you expect this to play out state to state in this country in the coming years.
Well, at the moment, for this exact, with the Senate trying to block this and this has gone ahead, the president will veto this. But I imagine, Jonathan, depending on whether or not it's a red or blue or purple state, that's how it is going to play out. When you talk about the oil and gas industry, though, it's interesting because it also puts the Biden administration in a little bit of a hypocritical position, because at the same time, they want to make sure that this rule stays intact and that these fiduciaries are looking at things like ESG when it comes to retirement planning. They also have been begging the oil industry to pump more. And the issue with the oil industry is they say that we don't have the bankers and we don't have the investment in New York and financial capitals around the world.
Anne-Marie, John pointed me to this Ron DeSantis op-ed, and one of the lines in here really highlights the bigger issue here. Yes, this is an ESG issue. Yes, this is a fossil fuels issue. But Ron DeSantis writes, the regrettable upshot of the woke ascendancy is that publicly traded corporations have become combatants in battles over American politics and culture, almost invariably siding with leftist causes. Has this sort of tilt toward ESG, environmental, social, and governance concerns, kind of made the Republican Party, traditionally the bastion of corporate America, suddenly pitted against the same corporate America that they used to support?
Well, I think that's the heart of what Governor DeSantis is getting at, right? And this also comes down to, when you're want to run a presidential election, you need massive amounts of money in America to do that. And what we've seen over the course of, really a decade, but this was incredible. It happened incredibly quickly during the prior administration, is employees at corporations really pushed top management to make different decisions and to make sure they were considering social decisions, and managements have moved on it. And so this is something that Governor Ron DeSantis is really trying to poke a hole in, and he's taking this message nationally.
Anne-Marie, thank you. Down in Washington, we'll continue this conversation in the next hour. Looking forward to that. Interesting to see the governor of Florida on a bit of a media tour at the moment, Tom, with a new book. That was a Wall Street Journal opinion piece to kick off the week. I think there was an interview as well with the Times of London as well on that book too. Just getting a little bit more familiar with the man down in Florida.
Yeah, it's a media tour, and it's also visits to states, and it's all wrapped around the primary season. Is Sir Keir on a media tour in the United Kingdom right now, the head of Labour?
No. I think they're always on somewhat of a media tour.
Yeah,
but it's interesting to see him engage the national media, the international media.
And the other 10 candidates as well as, Pompeo.
He's not officially declared yet, has he?
Well, no, they haven't yet, but, what are we in store for? 10 candidates? Does someone go challenge Mr. Biden if he decides to run for a second term?
Well, and then where is the gravitational force for both of the parties, right? And I think that seems to be one of the big questions that really gets raised with some of the discussions that we see in Washington. Is it going to be China, where there's bipartisan agreement? Is it going to be ESG to sort of signal some of the social issues that really have galvanized a number of the parties on both sides?
I have no idea how the middle of America polls on ESG. I have absolutely no clue. To me, it's a complete mystery.
I think it's pretty clear how they poll on energy. They don't want to pay a lot for it.
They don't. Absolutely. Every
that's
politician
what it comes
will
down
tell
to.
You that. Yeah. I mean, it limits my travel below 59th Street. I mean, it's a long way.
I personally think that it's become, you know, a trigger phrase that people, you say ESG, and you've got some people who are like, yes, and other people say no.
Totally.
And it's become completely politicized, and it's removed scientific analysis of what exactly needs to happen to reduce carbon emissions in a logical way while preserving, you know, enough of a lifestyle that people want to perpetuate politically.
No, agreed. And that's why I said when we started this segment, the term ESG is just being used really, really loosely here.
And politically,
what it comes down to for a lot of people is just whether you support fossil fuels or not, whether you want to support big energy in America.
But I think that if you talk to investors, it's much more nuanced, and even the fossil fuel companies are very much in on the transition.
Are they ESG at Formula One? Are they seriously?
I
are they
think
trying to save energy?
They're trying to become a little bit more
at 200 miles
like
an hour.
But Tom, at the end of the day, if you're touring the world for 9 months, 10 months, from city to city,
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so a lot of it is, it's part art, part science. We're trying to bring more science and more AI into it, because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Equity futures a little bit softer here. Good morning to you. We are negative by 0.4% on the S&P 500 in the second day of March, facing a test in the bond market. We'll get to that in a second. On the Nasdaq right now, down 0.6%. Here is your test in the bond market. It starts with 4 on a 10-year. 4.0221%, yields higher by 3 basis points. We had a 4 handle on a 10-year for the first time since last November. The 2-year looking at 490 a couple of times in the last 24 hours, up a single basis point there on a 2-year. Just signs, more signs that inflation is looking stickier. We had the ISM manufacturing read yesterday, the prices paid component. So this wasn't about the headline, which was still sub 50 and improved just a touch. This was about the prices paid component. A lift there spooked this bond market. In the FX market, the data point out of Europe about 90 minutes ago spooked a lot of people too, although we kind of knew it was coming based on the regional breakdown of things. We saw France, Spain, Italy, Germany, inflation still elevated, and across the Eurozone, core CPI, all-time high. Tom, 106.22, euro dollar negative 0.4%. 50 is absolutely nailed on. 50 basis points from this ECB this month. It's about whether another 50 after that is nailed on too, and a lot of people think it is.
No, and the new data dependency as we hang on every interest rate topic. I would look also at the 10-year real yield. One of the series that I use is really not at a technical breakout. It doesn't give me the drama of 4% 10-year yield, but the real yield at 1.58% is grinding ever higher. We're just not at a breakout.
Are we sufficiently restrictive with that in mind? Lisa mentioned earlier, I think Lisa asking the right question.
Feast.
Are we even at neutral?
I mean, I don't think people understand.
Never mind restrictive or sufficient restrictive.
If you take a look at real yields, or if you take a look at inflation expectations on two-year bases in the U.S., they're back to the highest levels going back to November. A concern about stickier, longer inflation in the U.S.
We're going to get Matthew right now. We do this with Dean Kernett. He's founder, CEO of Macro Risk Advisors, who writes a really adult, pro, math-driven, quant-driven note on where we are in the markets. Lean forward, and we'll try to sort through the jargon. There's a banded trend, Dean, of 2 standard deviations up and 2 standard deviations down. My calculation this morning on the 10-year U.S. yield is 2 standard deviations up is an elevated 4.1105%. Does your body of work suggest we'll get there?
Well, I think we're certainly all beholden to the data at this point, and we've got a raft of incredibly important data coming. I think there's no precedent for the big 3 macro catalysts from a data standpoint occurring in just 9 trading days. So you've got NFP, CPI, and FOMC all within 9 days. So it's exceptionally important, obviously, for the market. The vulnerability here to me seems to be to better news. So it's a good as bad sort of dynamic that crept back into the market. Right. And, as we sort of look at the different segments of the yield curve, we could look at 3-month, 2-year, we could look at 2s, 10s, 3-month, 2-year flattened, right? That was a head scratcher for a period of time, the speed with which the Fed was supposed to be cutting rates after raising them so quickly. That didn't make a lot of sense. That's normalized quite a bit. That curve is flattened out. And so the next one to sort of wonder about is something like 2s, 10s. So if 2s are up here at 5 and 10s are at 4, right, at some point the 10-year is just a succession of 2 years. And so we have to ask ourselves, what does higher for longer truly mean? The Fed commentary the last couple of days, someone like Bostic is not a voter right now, but it's pretty hawkish stuff. It's basically saying we're going to be up here in restrictive territory, at least in their mind, for a period of time into 2024. And then, of course, what we're all asking is, what does it mean for the real economy and for corporate earnings?
Are all the trends that you see around the cross moments, fancy talk like kurtosis and variance and the rest of it, do they suggest controllable, measurable trends, or do you worry about a disjoint or jump condition?
Well, when we use the word skew, at least in the equity derivatives parlance, we're basically talking about the extra premium that the market's willing to pay for out-of-the-money insurance. What's our experience with things like the 87 crash or obviously the great financial crisis is markets tend to crash down, not up. And so if I'm buying insurance, I'm charged an extra amount for that acceleration of down moves that typically occurs during a risk-off event. As of now, that skew premium is actually quite low. And it's low for good reason. It's low because it really didn't perform last year. The folks that are good sponsors of out-of-the-money puts on the S&P found that it just wasn't working probably by middle of last year. And so what do? You adjust and you try to take what the market's giving you. And right now it's not giving you those deceleration moves, to the downside. In fact, just a real quick statistic. Last year we had 46 2% moves, either up or down in the market. Right now this year, as of the first 2 months, we're on pace for 12. that is the engine for long vol. You need those 2% daily moves. And if you're not getting them, the VIX is going to struggle to get back up into the high 20s and 30s.
Dean, you talked about following the data. A lot of people have talked about data dependency, and yet even if you get the data right, you're going to get the market wrong potentially, because that has been sort of the theme of the frustration of 2023. How do you know how to interpret the data? Right now, data is being skewed to good data is bad data. How do you know what the right interpretation is at a time when you're trading on sentiment so significantly like you?
Yeah, so there's this old Stanley Druckenmiller quote. He said, the best economist I know is the stock market. And I think what he's basically saying there is market prices matter. They can be wrong quite a bit. That happens all the time. But we try to take the tells from the market. We look at correlations, for example. And, you know, one of the things, Lisa, we've talked a lot about is stock bond correlation. It was negative for the better part of 20 years. It formed the basis of the institutional portfolio construction, where in a risk off, you get your bond market rally, it would defray some of your losses in the stock market. Of course, last year, that came undone in epic fashion, and it's not ended. In other words, we're still in a positive correlation between stock and bond prices. So that's one thing I look at closely. Another one is just correlations to the dollar. It's been the anti-S&P for the better part of a year, and I think that's something we're supposed to watch as well. You know, the high point in risk last year was, I think, late September, early October. It was the gilt crisis, but it was also that chokehold that the dollar had on the sort of system of risk-taking. So we've obviously sold off in the dollar, but it started to creep back up. You know, we're supposed to watch that as well. And then just hit up the good old Bloomberg WIRP page. You know, look for, we're now north of 3 tightenings. That was supposed to be 0 as of a month ago. Getting into 4, boy, and now, you know, an introduction of discussions of 50 basis points, that's a new thing for the market to grapple with. So I try to look at market prices rather than, you know, predict the next economic data release.
Right now, the market pricing is actually not necessarily confirming this belief that earnings will be a driver of some of the downturn ahead. And I point to what Mike Wilson was talking about yesterday on Bloomberg Television with John. I'm thinking about what a lot of people are talking about, an earnings recession. And we see these earnings come out, with Macy's just out, where even disappointments are met with gains. There's a sort of bias to the upside. Is there a message in that from the stock market, or is the stock market wrong?
Well, we made an adjustment to the PE ratio last year. I think that was consistent with higher inflation and higher rates. So most of the damage that was done to the S&P was really just the multiple. And so what folks will say is this is the year where the impact of higher rates starts to flow through to the real economy and to corporate earnings. And, you know, you get to current levels of the S&P with something around a 17.5 forward PE and 230 on earnings. That's not my forte, but it just seems to me that keeping the short rate up here at 5%, knowing what it ultimately does to critical aspects of the U.S. economy, like the housing market, it's going to ultimately matter. And if I'm thinking about volatility and I'm thinking about hedging, the brightest line I can draw in terms of what moves the market is a deceleration of earnings. And perhaps what's happening, Lisa, is that the market is just waiting to see that you've actually going to have to see the decline in earnings for the market to start to move. But, you know, I think it is coming, especially if inflation is just not going away. It's going to be a long haul to truly get back to 2%. It's just going to be an incredibly long haul for the policymakers and I think for the market.
Dean, final word on this. August 2021, Dean Kerner comes on this program and he turns around and he tells us transitory is the new subprime is contained. Now, Dean, you just nailed it. Now, when we look back at the disinflationary process has started, which was a comment from Chairman Powell in the February news conference, how do you think we're going to view that phrase by the end of the year?
I think he was certainly half right. It had started. The question is, you know, how do you actually get to 2% if you're seriously about getting to 2%? It's really the QE period of the post-crisis era flipped on its head. Trying to get from 1.5 to 2 using 0 rates is kind of similarly difficult to get from 3.5 to 2 using a 5+% short rate. It's going to be a long haul, and it's just going to take a lot of time. So these, you know, we're in the immediate gratification business, investors these days, but it's just going to take a long time.
People don't have patience. Hey, Dean, thank you, buddy. As always, Dean Kerner there of Macro Risk Advisors. Got some headlines moments ago. Another retailer reporting. This time it's Macy's here in the United States. Rather like Target, it's a beat in the fourth quarter, but they take what they call a prudent approach to the outlook. So here's the beat on EPS for the fourth quarter. 188. The estimate was 158. Here's the outlook. They see full-year net sales, 23.7 billion to 24.2. That's a touch below the estimate of 24.32 billion. And Lisa, off the back of this, the stock positive by a little more than 5%.
Which really highlights how people are willing to look past the prudent approach, or some people would say kitchen sinking it, because they're being given a clean slate to basically come out with a really conservative gaming out of what they expect this year and saying, it's probably going to be better than that. One thing I want to note, similar to some of the other retailers, they said that the margin declined due to markdowns and promotions. This is clearing out some of what they had in their stockpiles, and perhaps that's compressed what their margins are in the past, but going forward, it could be a brighter story.
Let's put it in perspective. And there was young Lisa years ago going up the wooden escalator, which was iconic. I'm thrilled to say I had the privilege of doing it just before they ripped the thing out. 10-year track record of Macy's is like Kohl's and all the rest of them. An outrage. Negative 3.3% per year over the last 10 years. And what's stunning, John, and this goes to the world that we talked to Dana Telsey about and Vanessa Friedman of the New York Times. This is apples to oranges. Price to sales, LVMH, is 5 times sales. Macy's is 0.22. There's no other spread like that.
They're not quite apples to apples then.
They are not apples
TK.
to apples.
At all. I thought they still had the wooden escalator.
I've been there.
Maybe they do.
I thought they still had that on the top floor.
You just want to not wear high heels because they will get stuck in between.
Isn't that still on the top floor?
Thing.
I mean, I
think
haven't been there for a long
I
time.
haven't been there for a long time. That's just maybe an indication.
They've taken that away? I didn't know they'd taken that away.
Maybe I stand corrected.
Okay.
Maybe we've got to do a field trip, surveillance field trip. You're not talking about a road trip there.
Remote.
No.
With Santa.
Dan Ives of Wedbush.
You could have humored me.
I could just see John on Santa's lap.
Aw.
Okay. Tesla Investor Day. We'll get Dan Ives' thoughts on that next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. SpaceX launched a 4-person crew to the International Space Station early today. It includes 2 Americans, a Russian, and an astronaut from the United Arab Emirates. They'll arrive at the space station on Friday and stay there for 6 months. It's the first victory for Republicans in their crusade against the so-called woke capitalism. The Democratic-led Senate voted to block a Labor Department rule that allows retirement plans to consider environmental, social, and governance issues in their investment decisions. President Biden's expected to veto the measure. The European Union is set to propose a plan to provide Ukraine with much-needed ammunition. It calls for the immediate transfer of ammo, especially artillery rounds, from existing stocks. The proposal also envisions ramping up Europe's capacity to meet current and future needs. Meanwhile, the UK is pushing for closer financial services links with the European Union following the breakthrough on Northern Ireland. Treasury Minister Andrew Griffith will make the case for greater cooperation during a visit to Berlin today. Financial services were excluded from the post-Brexit trade deal that took effect in 2021. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We have only 8% of the ocean protected today. And our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least, 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish.